The markets are fighting the Fed, as they've frankly been doing all year.
The U.S. economy is just a lot more resilient than what the Fed, what economists more broadly were ultimately giving it credit for.
It should have been a really clear signal. Forget about the chance of cutting this year.
Powell has a tough job. He's going to have to sell, yes, we can get inflation down, but without a major recession coming.
The only way that I can really see the central banks being able to have that smooth runway would be inflation coming down off its own accord.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene from Core Inflation Headquarters in New York, radio and television. Good morning on a United Kingdom Wednesday. Lisa, the message from Britain is simple. Inflation is sticky.
Core inflation getting to the highest level going back 31 years. It was supposed to stay the same.
Perfect.
It is just
Reach.
mind-boggling when you think about just the fact that they have been fighting inflation. They have been raising rates. We were talking about some sort of recession. And now, what are we talking about? The possibility of 6% Bank of England rates. I mean, what are we talking about to get this down?
6% number, and Bloomberg with a really good set of charts off our United Kingdom economics desk today. And Bloomberg reports here on the way we've rolled over from the agony of the pandemic inflation, and United Kingdom just can't get it done versus Europe and versus a much better America.
You've asked a really good question in the past, which is how much is this having to do with Brexit? Right? How much is this because of the labor dynamics?
Can we go there before 10 o'clock?
Hold on a second. But there is this question. Is it the I word? Is it idiosyncratic? How idiosyncratic are the stories of inflation in the various regions around the world versus something more uniform due to the distortions post-pandemic and in a new deglobalized or reglobalized world?
We're going to cover this today, folks, because this is important. It certainly moved the markets to an extent. But you know, I sit here and I just look at every country is different. What I have to constantly remind myself is the United Kingdom is essentially, as an analog, 1/7 the size of the United States. And I just wonder about scale dynamics of Europe, of China, of the United States versus an island. I mean, I just think it's a different story.
Which is the reason why perhaps it's not easy. It's not easy to just simply say, well, Australia surprised to the upside, Canada surprised to the upside with respect to rate hikes, so too should the Federal Reserve. And yet here we are. The fact that around the world you have a situation with inflation surprising to the upside. What does Fed Chair Jay Powell say when he faces Congress about the hawkward pause, right? We talked about that yesterday with Peter Hooper of Deutsche Bank. How does he justify it?
Hawkward. Okay, I'm not there yet on a Hawkward. Ben Laidler writing, thank you, Ben, for joining us yesterday. And I like how he puts it. And Lisa, you followed this. John's followed even better than both. So Ferro's on assignment, folks. Just it's a continued assignment here.
Yeah.
It's an assignment.
Yeah.
But the basic idea here, Ben Laidler says, is we're back to Liz Trussonomics. I think that for Americans is maybe better. Yields up like the agony of the turmoil there with the prime minister.
The markets aren't cooperating with a narrative that makes sense to me. If you look at the pound, substantially weaker. This makes sense when it comes to inflation, but not if you expect the Bank of England to really respond to it. You're not seeing two-year UK yields at the highest levels going back a chunk of time. People are trying to figure out how far they're willing to go. And this, to me, is the key conundrum. How do central banks hike into recession, hike into slowness, hike into something that needs to happen, according to some people, in order to bring inflation to the levels that they want?
Sterling out to 127. Let's fold it into the data check this morning. And Lisa, I'm going to begin with 2-cent spread. This is the difference in yield, folks, between the 2-year and the 10-year, the vanilla spread. And as yields move up here, and, you know, I'm not in the 4% watch on the 30-year bond, 3.82%. But I've got further inversion out to 97 basis points. I'm going to say for the first time this morning, again, we're on the 100 basis point watch for a 2-year, 1 full percentage point higher than the U.S. 10-year.
From May 4th to today, benchmark 2-year yields in the U.S. have risen by about 100 basis points to 4.7%. You've had a complete repricing of some of the rate hikes that people had previously priced out. So I'm watching that and trying to figure out what this dovetails with respect to the UK call.
Quickly, a data check here. It's more lively than yesterday. We struggled yesterday. Bramwell, you didn't see it on the Bramwell cam. There is evidence. She snoozed off at one point. The data was so quiet. Fractional move in the stock market. The VIX, importantly, under 13.75. Some real oddity in the volatility space. We'll talk about that. BitDog gets a lift here, big lift off, big players coming into the Bitcoin.
I saw that.
I don't understand it, but 26,000 to 29,000.
There was a BlackRock ETF that was tied to the Bitcoin.
So I'm going to be able to buy
dynamics.
BitDog in my 401k. Is that what you're telling me?
All I know is that there was some kind of discussion about a number of institutions coming in. Here's what we're watching today. 10 a.m. Fed Chair Jay Powell heading to Capitol Hill for his two-day semi-annual monetary policy report. He is going to be testifying in front of the House today. The awkward pause. We heard this from Peter Hooper. How does he justify? I do, because it is awkward. How does he justify why they didn't go now if they're looking out at inflation that is sticky? Core CPI, yes, it's come in. We're still looking at a 5.3% core inflation read in the U.S. Austin Goolsbee also speaking today around 12:30 p.m. in Chicago. Today, also on the Fed front, nominees, Fed governors Philip Jefferson and Lisa Cook, as well as Adriana Kugler, currently U.S. representative to the World Bank, all heading to the Senate Banking Committee, at least some members of it, to possibly get their confirmation process underway. We heard from Philip Jefferson yesterday, and he kind of was a little bit more dovish than some of the other members. And even though he was emphasizing the inflation fight, I wonder, this sort of dual mandate starts to take on something a little bit more
interesting. He's a first-rate economist. I mean, the guy's hugely qualified to take any job at the Fed you'd want to choose. But he's also a different economist than others. You don't have the rigorous mathematics, the John Williams, Richard Clare rigor, the Bill Dudley rigor, frankly, from Goldman Sachs. It's a different flavor, but within that is still first-rate ability.
And we'll get into some of his comments from yesterday. Also today, just to note, President Biden is hosting Indian Prime Minister Narendra Modi at the White House. This one is going to be interesting, Tom, especially given the questions around the Ukraine and support versus Russia, as well as the technological outreach of some of the U.S. companies. They're looking to India as a place of growth.
Is that our brief for today?
Correct.
Okay. China, I mean, it's still, the news overnight of China, President Biden was just stating the D-word dictator. I mean, I thought that really leapt out at me as well. Lots of news flow today, and we'll keep you covered on that through the morning. The two-year yield, 4.71%. Following all this, excuse me, I think I got the air conditioning plague is what we're going to call it right now. Margie Patel joins us, and this is a wonderful way to start the show this morning. Senior Portfolio Manager, Allspring Global Investments, with the courage to look at dividends and dividend growth is a bond proxy. Where's that balance right now, Margie, between capturing yield in the bond market versus capturing dividend growth in the equity market?
Well, the short-term Treasury yields are very tempting, no doubt about it. But if you look at U.S. companies, they've actually never been better positioned. They're in a position to raise their dividends over the next few years. They're globally competitive. They have great balance sheets. And so I think that you have to look beyond this gasp of very high short-term rates and look at dividend plays, I think, and you'll make more money over several years.
Is UPS and FedEx, are they still the bellwethers going forward of the U.S. economic trajectory? And I ask this after FedEx reported earnings last night.
Well, I think they certainly reflect traffic and are a good picture of the economy. But whether they themselves are a good indicator by their profitability, I'm not so sure. I think the market's gotten more and more selective as far as what companies can have sustained profitability. And I'd say they look like companies that are really under pressure for a lot of reasons.
Well, I guess the reason why I ask this is because are we seeing an economy that is softening pretty substantially, as represented by the fact that FedEx reported lower revenues than people expected, just simply on volumes, not on their pricing power, even at a time when there are other companies having a secular breakout that don't necessarily represent the economy? Is that the best way to think about investing in a stock market that's increasingly divorced from an underlying economy?
Well, I think what it says is the companies, the sectors that can have above average growth at a time of low economic growth. I mean, maybe we'll be clocking along at, say, 1%, maybe 2%, maybe have a recession. So that says the amount of growth winners are relatively few. And I think that's why you've seen a certain group of stocks really do well and everything else is left behind.
Margie, are we starting a second leg of a bull market? You mentioned American, maybe a good place that American equities are in right now, American corporations. Can you identify a second leg of a bull market from October?
Well, I would say that we had this year really two big bursts of the market moving. One, and they were really driven by Fed liquidity. One was when Silicon Valley Bank failed. You had the Fed provide ample liquidity. The market took off. And again, when we had the debt ceiling talks, again, we had another burst of liquidity. So I think the Fed is going to be torn between stability, their goals of trying to raise short rates, and yet providing liquidity when we have some sort of a crisis that they feel they have to step in and avert. And I think that's why Powell sometimes seems like he's talking about both sides of the market.
Margie, I want to tilt the bonds here right now. And the raging debate on Bloomberg surveillance is the placement of a portfolio, whether it's an individual investor or someone fancy like Allspring, on duration. Give us the Patel balance of duration right now.
Well, I think medium duration, that is a duration of, say, 5 to 7 years, is really about the best place to be because you capture most of the yield that you get by extending maturity, but you're not so far out that you're vulnerable if there'd be a huge spike up in rates. You can still make money if yields fall in the middle part of the curve.
You specialize in bonds, Margie, and yet for a lot of the past year, you've been really highlighting your stock investments. And I'm wondering how that's shifted over the past years. Are you starting to shift a little bit more toward bonds and less toward equities, or are you keeping it more heavily weighted in the stock sphere?
Well, last year, bonds, treasuries, and corporates were not a haven at all. The market went down, and actually bonds, many sectors of the bond market actually underperformed the equity market, so they weren't very defensive. This year, everything except for that group of, say, a dozen names, high-cap equity names, everything is sort of low to mid-single digits. But I still think that there's a risk that we could see treasury rates actually move higher, especially in the short end. So I think that equities, because companies have restructured the balance sheets, are a better place to be. It's hard to buy at the absolute low, but I think you'll be paid over the next, say, year or two with their growth.
No, you're going to be paid by coupon. Let's call Dan Fuss here, the legendary Dan Fuss from Boston as well, Margie Patel. Are we clipping coupons or are we managing for total return?
Well, I think in the high yield sector, you have a chance to do both. And I actually think that's the most defensive part of the high yield, the fixed income market, ironically. Yields are, say, 7 to 8.5%. Most bonds are trading between, say, 90, 95 cents on the dollar. So if yields fell, you'd have a chance of a little capital appreciation. And defaults in high yield space looks very low, a little over 3% right now. And actually, the loan market has higher default rates. So it tells you that the construction of the high yield market is actually very high quality compared to historically. We have not seen much of a spike in defaults.
Margie, thank you so much. Margie Patel, Allspring at Global Investments. Lisa, to me, the takeaway there is you got to be in the market. I mean, I don't hear Margie Patel's talking cash is king.
No. In fact, even talking about the fact that short-term bond yields look attractive, but so too do 5 to 7 year bonds, which actually you can hold for that maturity. This is a tension right now, and you've talked about it. If you are getting yield in cash, what's the incentive to move out other than FOMO, right? What is going to be the next catalyst for the next leg of some sort of returns, or do you just have faith that stocks will do what they always do, which is go up, right? Over history, over the past few decades, that has sort of been what has happened. This, to me, is a tension that I hear underplaying a lot of people who are trying to justify why they've lagged behind as much as they have so far this year.
Yeah, my basic take here is the bulls and the bears are all modeling the E of PE earnings. Some are looking for a less resilient earnings story. Some are saying, earnings may not so much deliver, but actually be good. But the real issue is the PE expansion. Costin over at Goldman Sachs talked about this, the idea of that good feeling that we have. And forget about the big tech. It's also evident in other blue chip stocks.
Although, to be fair, just to sort of double down on what FedEx did yesterday, they gave a 2024 profit outlook that was below expectations, not on the amount that they were able to charge. They're able to charge plenty more, but volumes lower. That really speaks to something that's very uncomfortable for the Fed, increasing inflation even in the midst of a slowdown.
Sterling 127.05. The headline story today is United Kingdom core inflation back decades. Stay with us. This is Bloomberg Surveillance.
I don't think there is going to be a complete decoupling of our economies. I just think when you look at the enormity of the trade, where there's $500 billion plus a year between the U.S. and China alone, that's a lot of interaction. So I'm not sure we're going to see that. I do think that we are going to see on the sensitive sectors, certainly some concern that's been raised and some decoupling there.
He's got a fancy Wall Street title. Eric Cantor is Moelis Vice Chairman, former U.S. House member and Majority Leader. And what's important about Eric Cantor is he is the congressman from Richmond. That is a good setup here for our next guest. First, red and green on the screen. We're watching sterling 127.06 off of shock inflation in the United Kingdom. I haven't mentioned oil yet. 71.32 on American oil. On Eric Cantor, we're going to talk China here. Lisa's all fired up to talk to China. With Greg Villiers, that's the lead part of his note this morning. He's chief policy strategist at AGF Investments. But there's Eric Cantor, Greg Villiers, and you and I know he was absolutely flattened in Republican politics of a good number of years ago. Has the Republican Party changed at all since Eric Cantor? I mean, to me, McCarthy's in the same place as John Boehner, and there's an Eric Cantor right now trying to help McCarthy, and he can't get anything done.
Yeah, I think the party has gotten more strident in many respects in the House, which makes life, as we all know, very difficult for McCarthy. I think the other big story is China. And just a couple of comments quickly, Tom, on that. The little progress they made in the last few days was negated overnight with Joe Biden inexplicably ripping into Z. I don't know why he did it. And number two, I think that these stories out on a military base or a spy base or a training base in Cuba by the Chinese really is a serious, serious issue.
I agree, because you and I lived it. I have the clearest memories of my youth and the Cuban Missile Crisis. But I would suggest, Greg, there's not missiles involved here. It's going to be X number of soldiers 100 miles from Key West. I get that tension, but can you really equate it to a Cuban Missile Crisis of John Fitzgerald Kennedy?
Fair point. It's not as serious as 1962, but at the same time, it's going to give fodder to politicians who don't like China in both parties, whether it's Chuck Schumer or Kevin McCarthy. In both parties, China is not popular, and I think this will simply add fuel to the fire to speak out against the Chinese.
Greg, you mentioned Joe Biden inexplicably, in your words, going after Xi Jinping. I'll read you the actual comments. He was speaking at a fundraiser last night saying that the Chinese leader had been blindsided by the spy balloon, saying he didn't know it was there. That's what the great embarrassment for dictators, where they don't know what happened. And that was what really keyed off some of the concerns with people calling that irresponsible and saying that really does heighten tensions. What do you make of the why behind President Biden's comments? Was this some sort of diplomatic foray, or was this another faux pas that's going to be sort of highlighted as kind of emblematic of his presidency?
Well, first of all, Lisa, you got to say, it looked to me anyway that the balloon story had been, buried. I think we put that behind us 3 or 4 days ago, and Biden resurrected it. So this could be just part of a string of gas we've seen recently by Biden. After one speech last week, he said, "God save the Queen." There's things that he says that leave people scratching their heads, and it's to be serious for a second, it does plant seeds of doubt among a lot of Democrats who are reluctant to vote for him.
Well, just putting aside the election for 1 second and just doubling down on the theme, do you actually think that this could materially worsen relations with China, that the relationship is already so fragile that a gaffe by the president, just simply mentioning the word dictator, could undermine everything that Tony Blinken accomplished while he was overseas?
Well, it doesn't help, does it? It makes things more complicated. And I'm sure just as you have angry lawyers working for Donald Trump who are shaking their head over Trump's interview with Bret Baier, you see a lot of people, I'm sure, close to Blinken shaking their heads over why Biden would say something that, to me, reckless.
Greg, what do we follow into July? I mean, I think for so much of our audience, we're exhausted by this story. We glance at the Post, glance at the Times, glance at Bloomberg Politics, etc. But what's the thing to follow into July?
Well, we've got today, as you know, we've got Jerome Powell, but I would say throughout the summer, the number one story is Ukraine. If this war doesn't go well and they got off to a fairly slow start, I think it'll lead to a lot of anxiety that the West and the U.S. may lighten up on our aid. We're not at that point yet. I think this is still a winnable war, but I think there's got to be signs of progress. So to me, that is the story for the rest of the summer.
I want to take the military and its effort in Ukraine, swing it back to the Pacific Ring, Greg Valliere. And one of the clear things we see is an expansion of the United States military across the Pacific Rim. It seems to me to endure. It's not only a discussion, it's now being budgeted and planned. Is that how you see it?
Yeah, I think so. There's going to be controversy in the House on how much we're going to spend on Ukraine in the budget. And I would say the number two issue for the next 2 or 3 months will be budget. And I don't want to sound like the little boy who cried wolf, but I think chances of a government shutdown on October 1 are a little bit above 50-50. So that's going to be a big deal. I think at the end of the day, the defense industry and Ukraine get plenty of money from the U.S.
We know that, just to double down what you were talking about with respect to Ukraine, and that you think that's going to be the key worry. Are you expecting to hear exactly what the progress is, how Ukraine is defending against a Russian offensive that, by a number of reports, is getting perhaps more savvy? How much are you looking for intel from the Rebuild Ukraine conference currently ongoing?
Well, of course, as we all know, the first casualty of war is the truth. So it's hard to discern what is true and what isn't. I just think this is going to be a long slog. I think people were unrealistic, thinking that the Ukrainians would just romp during June. Well, they haven't, but we still have a long way to go this summer.
Greg Valliere, thank you so much. Greatly appreciate it with AGF Investments this morning, really with a focus there on China. You know, to see Eric Cantor there, I've seen him in Davos any number of times as well, and he's in, like Peter Orszag, he came over, and Orzag's at Lazard, and Congressman Cantor is, forever he'll be Congressman Cantor to me, but he's over at Miles. And it just hasn't ended for the Republican Party. I remember the blow-up where literally his career ended, and he was upset by a conservative voice in Richmond, Virginia. It was a shocking upset of Eric Cantor. Nothing's really changed here, and it leads to not so much Republican versus Democrat, but Republican versus Republican going on to November of next year.
You're seeing that in both parties, Republican versus Republican, Democrat versus Democrat, and the emphasis is more on Democrat versus Democrat perhaps a couple of years ago, and now very much in terms of the Trump supporters who's basically backing him and saying that the legal case against him is unfair versus those, including some of the leadership who don't want to go there, who don't want to necessarily undermine the concept of the rank and file in a lot of the institutions investigating some of these cases.
Really important. We're going to switch to Bramo, the Bramo world right now, which is taking all the bonds and summing them up, high yield, corporate, and the full faith and credit. There was a straight line for 15 years? I think Bill Gross pointed that out to me once. Price up, yield down. And that all ended with a vengeance, with a 15% rollover as a general statement. And it does look like the old dead cat bounce. We've bounced off that bottom. I can give it to you exactly, folks, here off the Bloomberg. October of last year, that's right, with the equity markets. And then here we are. And the raging debate on coupon to me, Lisa, is which way do we go in an aggregate bond investment? Do we go price up, yield down? Or do we see yields move higher like we see in the United Kingdom today?
Or do we bounce around and people can kind of collect the coupon and hope to be okay? Speaking of the credit world, did you see this bondholder suit from Credit Suisse, AT1 holders in New York, where basically they came out? I love this. You know, we talk about the culture of Switzerland. They said, while Credit Suisse began as a conservative Swiss private bank, the vast majority of the people who were responsible for its demise were not staid Swiss bankers, but rather sharp-elbowed New York investment bankers. Basically, blame New York.
Well, or you could blame London too. Let's bring London into it as well. It's got to be a huge trail of litigation for Mr. Armati and UBS. I mean, where are they in 24 months?
Which is the reason why they required such an incredible backstop by the government.
We say thank you to our Bloomberg team in Zurich and London, particularly John Patrick Barnett, for the great contribution on Swiss banking and Credit Suisse. Red and green on the screen, flat markets. Stay with us. This is Bloomberg Surveillance. Good morning. Surveillance. Good morning on radio and television. Jonathan Ferro on assignment. Lisa Abramowicz and Tom Keene here with you. A more interesting day than what we saw yesterday, Tuesday. Certainly, we'll get to it in a moment. United Kingdom must listen right now for Global Wall Street. Stay with us on radio and television. Neil Shearing's going to kill it here on the state of Mr. Bailey and the Bank of England. Futures up 2, Dow futures up 16. The VIX under 14. This is important. The VIX, this lack of volatility, 13.71. I featured out on Twitter overnight. Lawrence McDonald has written a tour de force on the lack of volatility out there with all these unspeakable derivative tranches that I can't keep straight and I don't pretend to understand. And Lisa, the first order condition under all the derivative bets and speculation, which is the massive amount of money into passive investments. I mean, the first order condition, the wall of money in private equity, the wall of money in public equity, the wall of money in bonds, to Sir John Templeton, a shortage of bonds, the massive wall of money into equity ETFs. It just goes on and on.
And one thing that perhaps is underappreciated is if people are piling into indexes because they see the gains driven by AI, it affects all the other stocks as well. And so the money starts to trickle out. And this is one of the theories behind a broadening out. We are focused, of course, as well on the UK story, as you mentioned, and this idea of a broadening out in inflation. We'll hear about potentially some of that from Austin Goolsbee, one of the Fed speaker who's going to be speaking, as well as Jay Powell. But before that, Neil Shearing of Capital Economics weighed in on the economic outlook, writing, quote, "The recent stickiness of core inflation and the likelihood of further interest rate increases in the U.S., Eurozone, and UK in the coming months make a downturn at some point in the future more rather than less likely." Tom, this is the real tension right now, given high inflation may necessitate some sort of recession down the line to get it under control. At the same time,
it drives me nuts.
When you're talking about a wall of money.
Where's my Tang Zero? I got to have a Tang.
What drives you nuts, Tom?
I just don't believe a central bank can get out there and force a recession.
Well, what do you think?
I think the evidence on that is pretty sketchy.
If you raise rates high enough, you start to get credit problems. And at a certain point, do they prioritize the idea of bringing inflation under control, or do they prioritize the idea of furthering growth without that kind of recession?
I think it's a mystery as well. Tang Zero is calming. It's a calming influence. Also a calming influence is Neil Shearing. He's Global Chief Economist, Capital Economics, and he writes shorter but dense treatments on what is going on now. Neil, how unique is the United Kingdom? How discrete is the inflation story? Or does it have an ability to shock and spread out to other nations as well?
Well, at the moment, it looks like it's a UK story. The UK inflation picture looked pretty similar to that in the US and the Eurozone 6 months ago. It was primarily about energy inflation, food inflation, and core inflation. Now, over the past 6 months, headline inflation has come down in the US and in the Eurozone. Core inflation has started to fall back too in both of those regions. But in the UK, core inflation is going up. It's now at a 31-year high in the UK. So headline inflation is coming down, but core inflation is going up. And of course, it's that was going to trouble the Bank of England.
I don't play the Fed parlor game, Neil Shearing, but I'll play the BOE parlor game of tomorrow. Can you tilt towards a 50 basis point rise as they join Catherine Mann, among other hawks, and say, let's get this done?
Well, look, it's going to be finely balanced, I think, is the first thing to say. But I think the balance will probably shift towards 50 basis points, yes, on the back of this inflation data. I think if you're the Bank of England, you're desperately trying to get back ahead of the curve. The market's pricing in, as we speak, about a 45% chance of a 50 basis point hike. And once that starts to get to 50-50, the risk, of course, is that if the bank doesn't deliver, then the pound falls, financial conditions loosen, and that's exactly the last thing the policymakers in the UK want right now. So I think on balance, if it were me, I'd be voting for a 50 basis point hike tomorrow.
Neil, I was talking about this, the potential for central bankers hiking into this higher than expected core inflation that remains sticky. And he said, no way, I don't buy it. And I said, I'm straight to Tang Zero, because he was concerned about the precedent of a central bank trying to induce recession, that really hasn't been done to such a degree at a time when, yes, they want to slow things, but they do have a dual mandate also with employment. Do you think that there truly is the resolve to go at inflation, even if it causes a recession, in places like the U.S. at a time of an election cycle, at a time of some very new members?
Well, of course, the Fed is in a slightly different position to the Bank of England with respect to its mandate, a broader mandate, and obviously has that employment goal too, whereas the Bank of England's mandate is primarily about inflation. So slightly different in respect to their individual mandates. But the broad point, I think, is the key one, isn't it? Is how much tightening do they need to put into the economy? How much do they have to dampen down on demand in order to get inflation under control? How much will it just come down naturally as some of these pandemic-related distortions start to ease? Now, I suspect in the case of the Fed, they've done a lot already. They've already got rates well above their neutral rates. They were earlier than the Bank of England to hike. They've tightened more aggressively, and the inflation dynamics in the US look less troubling than they do in the UK. In the UK, they're later to tighten, and the inflation dynamics are more troubling. The housing market in the UK looks like an accident waiting to happen too. So you put all that together, and I think it's less about whether the Bank of England wants to cause a recession or more whether a recession is collateral damage in respect of its inflation fight. And I suspect at this point, the economy's collateral damage, a recession will happen. But we need to get on top of inflation.
How much is the English story, or the UK story, I should say more broadly, partly due to Brexit, partly due to workers not coming as freely into the nation, and because of perhaps some of the investment in the housing market?
Well, we can't talk about the UK without talking about Brexit, can we? I think it's a factor. I don't think it's the only factor, but I think it's a factor. I think what's happened in the UK is that on the supply side, there has been a much greater hit to potential GDP, potential supply in the UK, than has been the case with other advanced economies. And part of that is Brexit. It's about the way that Brexit has held back investment in the UK, but also altered the flows of migration into the UK. So we've not necessarily had less immigration into the UK, but we've had a different type of immigration. Some European workers have moved back to Europe. We've got different types of workers coming from different countries with different sets of skills now. And that has implications for the labour market, and it's manifested itself in labour shortages in some sectors that have contribute to wage growth, and that in turn has fed inflation.
I mean, Neil Shearing, I know you saw Taylor Swift upcoming here. You've got tickets for Liverpool and London, but folks, this is the kind of needle that gets moved. They actually mention concerts and live venue in the inflation story in the United Kingdom, including Miss Swift going from Edinburgh to Liverpool to, I think, Cardiff, and then Shearing has 2 nights back-to-back at Wembley Stadium with Taylor. Okay, that's one idea of inflation, but there's got to be a different story here, Neil, to what makes the United Kingdom unique. Is it a goods services mix? Is it just an overwhelming productivity failure? What's the capital economics distinguishing feature of this inflation?
Well, it's certainly nothing to do with me or Taylor Swift. Let's quash that rumour before we get started. I think it's much more, as you say, it's about the supply side, it's about productivity, the weakness of productivity, the fact that investment as a share of GDP has been rock bottom.
So what are they going to do about it? I mean, I sat with Mark Carney a zillion years ago in a small Swiss village and talked for hours with Governor Carney about this off the record. We don't need to go into the details, but what is the Neil Shearing solution to this modern failure of the United Kingdom? How do they jumpstart productivity?
Well, I think that there are several strands to it, and if it was that easy, we would have done it already. So the first point is it's quite difficult to pin it down. A lot of it has to do with rebooting investment, and it's about having a stable, predictable business environment, getting a Brexit deal that both major parties agree to and will stick with, so that business environment is more secure and certain for companies when they invest. It's about public investment, which had been picking up. So government investment in the economy had been picking up in things like infrastructure, but is now turning back down. So I think we need to get that restarted. It's about sorting out the mess in the labour market, addressing labour shortages. It's about fixing problems in the National Health Service and making sure that worker sickness doesn't become an issue. There's a whole host of interconnecting issues. I think that's the point. These interconnect, they feed off one another and they amplify one another. So it's not just as simple as saying, right, here you go. It's, boost investment by doing X, Y, and Z, cutting taxes, whatever it might be. It's not that simple.
So from the UK to the US this afternoon, we're going to be hearing from Fed Chair Jay Powell starting around 10 a.m. Eastern. What are you looking for in terms of rectifying the message that a lot of people thought was pretty muddled last week?
Yes, exactly. I think that's the key point, isn't it? Can we get a bit more clarity on the message from last week? Are we in a skip? What will happen in July's Fed meeting, FOMC meeting? Are we back to hikes then? If so, how many? How are they seeing the kind of labour market situation evolve? It's the labour markets, the same true in the UK. It's labour markets that are key to this inflation story. So I think anything on the labour market and anything on the evolution of inflation, what happens beyond July's meeting when a 25 basis point increase looks like a lock? What happens after that? We've
gotten some better than expected home builders data, as well as just in general economic data and stronger than expected inflation around the world. Do you think, all things being equal, that increases the chance of some sort of more serious recession in the U.S., or decreases it because there is this resilience, this momentum?
I think it's important to understand which sectors of the economy, not just in the US, but across advanced economies, are resilient. The same goes for China, by the way. The manufacturing sector, by the way, is not resilient. There is a recession in manufacturing across advanced economies. You look at the PMIs, you look at the industrial production data, manufacturing data, you look at some of the goods trade data. It's all pretty ugly. The new orders balances of the ISM manufacturing index, it's all at recessionary levels. But you contrast that with the strength of services and the resilience of consumer spending on services, particularly things like leisure and hospitality. Perhaps a legacy of the pandemic. We're still going out to restaurants. We're still prioritizing that leisure and recreation spending. Perhaps some drawdown of pandemic era savings, helping to support that in the face of a real income squeeze too. That, of course, won't last. So different sectors of the economy are performing in different ways. So I just push back against this idea that economies overall have been resilient. It's some sectors that have been particularly resilient.
Neil Shearing, I hope the leisure is good at Wembley Stadium. $4,000 a seat for Neil Shearing to see Taylor Swift. He's with Capital Economics. Doug in Florida, thank you for emailing him. And Lisa, this is a disinflationary tone from Doug Cass. He points out, forget Taylor Swift at Liverpool or Cardiff, or with Neil Shearing at Wembley. Cass, Citi Field, Thursday. Debt and Company, you and me, Lisa, Section 529, $119 each. Cass saving us money this morning. 529. You could see Jerry Garcia on stage.
Okay, perhaps it's not the same kind of growth concert that perhaps Taylor Swift is. I mean, this is sort of the issue, right? It has a set group of fans that isn't growing exponentially the same way that Taylor Swift perhaps is. But yes, this is what I understand. I know people going to that concert.
The wonderful Alan Kruger missed every day from Princeton University. Loved this so much, he actually did a book on the economics of tickets and concerts in rock and roll. Is a somewhat microeconomic exercise for his students at Princeton. It was really interesting. I think it had to do with Springsteen tickets.
Sentiment, or is it the idea of what one song or one spirit or one...
It's what the market will bear. I mean, Neil Shearing, he's not going once, he's going twice to Wembley, to see Taylor. But, on Cass, I think Chairman Powell, I believe there was a Chairman Powell sighting at Dead & Company outside Washington.
And Dead & Company's Twitter post highlighted, by day, Fed chair, by night, deadhead. And that perhaps is who will be testifying on Capitol.
Maybe he should wear the garb he wore to the Dead & Company concert when he does the next press conference.
He was wearing a button down. He did not change. It wasn't as if he was wearing tie-dye and a hairband or something.
Okay, I'm glad we've had some research on this. Bramo, with your Dead & Company research there this morning. We're going to do Dead & Company if we don't do a data check, and we do it with higher yields. Important, a 30-year bond, 3.82%, 3.74%. On the 10-year and the 2-year yield, we're watching Lisa and I front and center on further curve inversion out to 97 basis points. We'll dive into that through the show as well. That's important. John Ferro on assignment, Lisa Abramowicz and Tom Keene. Stay with us on radio, on television. This is Bloomberg Surveillance. Good morning.
markets are fighting the Fed, as they've frankly been doing all year. I think the market is, more aware of the upside risks and is happy to maybe look through, maybe one or two more hikes. Whereas the Fed, I think, is going to be hanging on till absolutely the last moment. They don't want the market to loosen financial conditions off, prematurely.
Ben Laidler there, the bull. There's no question about that. You got to be in the market to participate. And Ben Laidler has done that. We thank him for his appearance today. Marky Patel at 6 o'clock was in a different way, but equally as constructive as Mr. Laidler.
Which I'm struggling with a little bit, not because it flies in the face of all the bearishness earlier this year, but because there is an increasing discussion about stickier inflation, consumer tolerance to price increases, necessitating a bigger response that curtails the growth. This is the tension to me right now, underpinning
There's
a market.
huge tension. I totally take that point.
That does want to melt up.
I really agree with this, folks. Into 6:30:23, this is a huge point of tension. And I would say the major tension is the percentage of people that are not enjoying SPX up 14 or 16%, plus or minus 200 beeps.
What Neil Shearing just said of capital economics was fascinating. This economy hasn't been so resilient. There are pockets that have been decimated, and there are pockets that have been incredibly strong. And this is the issue with trying to come top down and come up with these assumptions. How do you understand such a bifurcated economy?
Well said, Lisa Abramowicz. Ferro wouldn't have said that. I mean, top down, folks, and then there's bottom up. We're going to do it right now. Market check, we're flat. The VIX under 14 is a shock, 13.72. We'll get into all that later. I'll do a complete data check here at some point. This is a joy. There's a thing called Star Mine. The Wall Street Journal with the great Fred Wiegold missed every day. The great Fred Wiegold invented the Wall Street Journal Beauty Contest, which was really important. I personally saw that change people's lives. And there's a thing called Star Mine that was even more accurate, and that changed people's lives as well. One of them was a guy at Prudential a long time ago, Lee Klasko, who we all read surreptitiously. We don't want to talk about it, but yeah, we're bored with freight. Boring freight. And then FedEx exploded onto the scene, and Lee Klasko became truly an expert on logistics across America. He's brought that to Bloomberg Intelligence, and we're thrilled. He's here. There was like freight before FedEx, and then there was freight after FedEx. When you were doing the grind, what was it about FedEx that was shocking when Fred Smith invented the company?
Yeah, well, we like to think we were bringing freight back to being sexy. But Fred Smith really created a new industry when he created FedEx. He invented the air freight industry. And so, FedEx is a very interesting network because it's an air freight network that then decided to be a ground network, where UPS is the opposite. They started as a ground network and then decided we want to get into the air freight business. So some of the nuances between FedEx and UPS are kind of based on where their roots are initially started. And Fred Smith now is kind of has taken a step away from the company. He's still involved as an executive director, but from the day to day, he's doing a lot less. And so, I think we're entering a new chapter in FedEx, which is actually a good thing because FedEx has gotten a little bureaucratic, a little fat, if you will, over the years. And
it was always relying on growthiness to it, because the heart of the matter is like Kroger's, it's a 4 cents on the dollar business. I mean, the net income line and even EBITDA is not all that great. The new FedEx, what did you learn yesterday in the earnings report about this transaction from the bloated FedEx to some new beast that can do better?
I think they're making incremental progress, which is a great thing to see. I mean, incrementally, they're reducing costs. They have longer-term $6 billion in costs that they want to take out of the company. They're also reducing their CapEx from last year, and that CapEx is going to go down over the next couple of years, and that's really driven by the fact they don't have to buy as many planes as they once have. They're in a process of modernizing their planes and their fleet, which will improve their overall fuel efficiency and their ability to meet changing demand dynamics. But those needs to buy those new, very expensive planes are reducing because the age of the fleet is being reduced, and those really uneconomical old MD planes are being retired.
Before we get into the nitty-gritty, you asked a question. You started with talking about the distinction between FedEx and UPS and the other freight carriers. Is FedEx representative of the overall economy for goods in the same kind of way that it used to be, the same kind of way that UPS is?
Sure. I mean, absolutely. Because, I mean, they cover B2C stuff. They cover B2B stuff. They also cover freight for the industrial economy. They're one of the largest less-than-truckload carriers, which is really synonymous with the fact of bringing manufacturer, industrial production goods to market, in addition to e-commerce and other end markets.
Given that it does have a finger on the pulse in that kind of way, is there some signal from the fact they could raise prices for consumers quite considerably? That wasn't the issue with their reduction in their profit forecast. But volumes are going down in a much more material way than a lot of people had previously expected. Does that tell us something deeper about the economy, particularly with respect to goods?
Well, I think it's interesting when you look at the freight market. We've been in a freight recession for a couple of years now, maybe a little over a year, we'll call it. And that's really across all modes. So if you're looking at truck tonnage, you're looking at truck loads, you're looking at railroad loads or air freight, anything container liner. And that's really because we're getting to a new normal of freight demand. You know, as we all remember in the pandemic, everyone was buying stuff. There was a huge rush. There was a dislocation of the supply chain, which created increased demand, and people were panicking, oh my God, I need something tomorrow. And now we're just getting back to a new normal. And so when people say, like, you know, volumes are down, the sky is falling, I would just say it's not. We're still better than we were prior to the pandemic.
What I find interesting is they're still able to raise prices.
Yes.
And it doesn't seem, particularly in the airline industry, perhaps also in the freight industry, there hasn't been that much consumer pushback to price increases because people have gotten used to them in the post-pandemic world. Is that what you're noticing? That there isn't necessarily the consumer pushback that some people would expect to pay more to send their packages, even if they're sending fewer of them?
Yeah, and I think also a lot of people have the perception, which is true, that inflation is real and people need to increase their prices to generate a decent ROI. And so, you know, and they also, let's not forget, they are a duopoly, right? So they do have that pricing power. And they also can be more selective in what kind of freight they're taking. If customer A does not want to take a rate increase, maybe they will decide not to do as much business with customer A versus customer B, who was willing to take a 3% GRI and committed to, you know, a certain amount of freight per year, which is something that FedEx or UPS wants because they wanted the predictability of their network.
I took a log regression of FedEx back, and it's remarkably on trend going back 20 or 30 years, coming off the October low and a big surge up here. I know you don't do buy, hold, sell, Lee, but is this a company that you see, frankly, like UPS, where there can be a return to FedEx exceptionalism that we were weaned on, or is logistics just going to be a mid-trend provider?
The reality is FedEx lost its way, and it's now finding its way back on the path.
Well, what's your optimism on that? You're grinding it out in the conference calls and all that. Are you optimistic that they find their way back?
I am, and you know, some of that, I think it's going to be interesting who they pick as the new CFO. I think it's got to be an outsider. It's got to be someone who maybe is willing to make the tough decisions and making severe cuts to an organization that, you know, like I said earlier, maybe have gotten fat over the years. And so, you know, they are embarking on a restructuring of their ground and express network, which is something that they were very adamant that they were never going to do. And they finally, you know, capitulated and said, we have to do it to be more competitive to a UPS. And we saw, you know, Carol Tomé, the CEO of UPS, you know, since she's had the helm of that company, and she's not an outsider, but she was on the board, but not a UPSer for life, you know, she's done transformational things at that company.
Do you look at DHL as well? I mean, if I get afterthought address out of Paris, sometimes I get the package from France quicker than I do from Dallas, Texas. I don't get that. Is DHL killing it worldwide?
I mean, they are one of the leaders. We covered DHL too at Bloomberg Intelligence. You know, they are another interesting company because they truly have their hands in a lot of the supply chain, whether it's contract logistics, freight forwarding, delivering mail in Germany, or, you know, delivering your packages from France.
Lee, thank you so much. Lee Klaskow with us, Bloomberg Intelligence. A brief on FedEx. I learned a lot there. I mean, FedEx was like a layup
about where you order clothes from for your offspring.
Well, you know, I mean, you know, we have to put them in their garb, as they say.
Yeah, well, the Abramowicz household perhaps was a little bit more tempered by the oil barrels in the living room, and someone suggested that they were coddled by protesting yesterday.
It's an interesting business, but I take your point yesterday that what Lee Klaskow covers is the foundation of the modern America. You know, it's not like just trucks out of Arkansas moving chickens around. It's like logistics is a big deal.
I honestly think this is like The Graduate. You know, what's the future? Not plastics, logistics. It's all logistics. I'm very much a logistics fan. I will say also, though, that this actually, the idea that people are not pushing back against price increases, this is a bit of a warning flag on a lot of levels.
There we go. Here you get the Bramo glue.
There you go.
FedEx. It's un-American. Futures flat. The VIX 13.74. What am I watching? 2's10 spread out near 100 basis points, 97 basis points with that elevated 2-year yield. Please stay with us. Another hour of Bloomberg surveillance. Chris Harvey, must listen.
The markets are fighting the Fed, as they've frankly been doing all year.
The U.S. economy is just a lot more resilient than what the Fed, what economists more broadly were ultimately giving it credit for.
It should have been a really clear signal. Forget about the chance of cutting this year.
Powell has a tough job. He's going to have to sell, yes, we can get inflation down, but without a major recession coming.
The only way that I can really see the central banks being able to have that smooth runway would be inflation coming down off its own accord.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Ferro on assignment, permanent assignment. He'll be gone for, I don't know, is it like another day or two?
Another
or
week.
something in the
After
week?
this week. I was going to be gone a couple
this
weeks
week.
on a well-deserved vacation.
It's a British thing. I mean, Lisa and I haven't done this in 42 years. Ferro takes 2 weeks off every year. It's like, you know, well, the Queen does and the King does, so I can.
They're correct, and we should too. That's
They're
all I have
right,
to say.
Ferro's right,
Exactly.
we're wrong. That's the banner.
That's a banner
Make
for
a
you.
banner for me, Amy, please. Ferro right, Bramo and Keene wrong. That's the way it is right now. We've got an interesting day, more interesting than yesterday, and as we said in the last hour, yet by United Kingdom's stunning inflation. In this hour and in moments, we're going to explain the big tech boom. It really overwhelms every conversation in equities right now.
And perhaps distorts our understanding of whether the economy is slowing down or speeding up. If there is a lot of sections that are slowing down and AI and the tech boom overwhelms it, does it matter? Or can it keep chugging along because of what we see in terms of the promise of technological advancement?
Earnings season seems distant on big tech, and we'll do that at some point here in the coming weeks. We got the banks coming out in, I'm going to say, the third week of July, maybe the second week of July. But the answer is this equity market continues. The levels 44.34, SPX 34,300, Dow not near 16,000, NASDAQ 100, but we're, you know, it's up. It's been a huge, huge year. And the VIX says it all. And the VIX goes to the volatility conundrum right now. Dean Kernert was brilliant yesterday with Paul Sweeney. 13.73 on the VIX is an oddity, to say the least.
July 14th, that is when JP Morgan kicks off the earnings season. Apple and the likes later in the month of July 28th will come out with some of those earnings. Your emphasis on that is an important one.
But we're going to do it right now with Chris Harvey. Let's get to it. Let's get to the brief, though. I think, Lisa, this is just a really important, it's the conversation right now.
Fed Chair Jay Powell, that is going to be the conversation later on this morning when he takes the helm over at the House panel. He's having a 2-day semi-annual monetary policy report trying to explain the hawkish pause. I keep going back to the hawkward moment that Peter Hooper coined. I think it's important to note that this has been a pretty muddied message saying we do think that we need to do more. Why not do it now? He's going to have to explain that at a time when core CPI is still very high relative to the goal of 2%, 5.3% in the U.S., and an upside surprise over in the U.K. this morning. We also hear from Austin Goolsbee around noon, 12:30 p.m.
He's going to have
Eastern.
a different story. I mean, Goolsbee, you know, is distant from Bullard, I think we could say as generalization.
He is on the dovish side, yes. Yeah. And that seems to be the tone of some of the new members as well. Fed governors Philip Jefferson among them, as well as Lisa Cook and Adriana Kugler. All of them, Adriana Kugler is currently U.S. representative to the World Bank. They're going ahead of a Senate Banking Committee to discuss their potential nomination, their potential confirmation on the board. Just to give you a sense, to your point, Philip Jefferson yesterday said that inflation has started to abate and that the U.S. banking system is sound and resilient. He's talking about the different polls here, yet tilting a little bit more on a measured rather than hawkish kind of approach. And today, President Biden is hosting Indian Prime Minister Narendra Modi at the White House at a time when a lot of people are looking to India as the driver of any kind of EM growth. That is where a lot of the tech companies, including Tesla, did you see this? Elon Musk planning a trip to India and talking about possibly.
It just goes up, up, up. I mean, that's all there is to it. I mean, it's like on the edge of
Tesla or
It's
India?
No, Tesla. It's like a meme stock. I mean, I don't know. I don't own it. It's not in the triple leveraged all cash fund. That's what I know. We're going to get started here, folks. And for Global Wall Street, this is the high point of the day. Christopher Harvey. If you go to Bucknell University, the idea the chem majors are the nerds at Bucknell. Chris Harvey wasn't a chem major, but he was at Bucknell, which is like the Bucknell bubble. All you do is study finance with you because the winters are so cold. He joins us now, equity strategy at Wells Fargo. Your note, Chris, is absolutely brilliant about thinking back to 1998, 99, into 2000 and 2001 in the tech, the analog of looking back. What's the number one message in your study of this tech bubble versus that tech bubble?
So the number one issue is tech is not going to roll over. The major theme is not going to roll over until you crack the economy. That's what happened back in 99. That's like what's going to happen now. And I don't think you crack the economy until the Fed gets more aggressive. And so we'll have some wiggles. I think we'll have a pullback in the market. We'll have a pullback in big tech. But that overall theme is still in place. And not until the economy breaks do we really think about that trend breaking.
Is tech a set of individual companies that you study at Wells Fargo, or is it this amorphous sector blob up there like a 1950s sci-fi movie?
We do study tech. We do study individual companies. But what we do is we focus in on a lot on the Uber, what we call the Uber cap, or the top 50 names. You can look at one or two names, and that's great, but that doesn't give you a trend. And we look at the Uber caps because as you go across capitalization, small cap, mid cap, large cap, they all have characteristics. And the Uber caps are the ones that really have that AI exposure, that tech exposure. And again, going back to 1999, that's one of the things that we did see. We saw that Uber cap outperformance, we saw that tech outperformance, and before all that, we saw the economy and the old economy stocks roll over.
You said something I want to pick up on. You don't crack the economy until the Fed gets more aggressive.
Right.
Are you saying the Fed hasn't gotten aggressive?
Lisa, the Fed has gotten aggressive, but I think we can all agree that the economy is a lot less interest rate sensitive than we thought. The way we're characterizing the economy is an economic malaise. We did think we thought the probability of recession spiked with the banking crisis, but now we think that's come back down. And so we're really looking at an economic malaise more or less than a recession on the horizon, right? The consumer is still okay, still has cash on the balance sheet, eating through their savings, but still has savings. Corporations still have plenty of savings. Balance sheets are much better. And so really you need some sort of shock to get us into a recession, or you need a lot more time. This is taking a lot longer than we expect, and I think it will take a lot longer than we expect.
Do you think that the amount that people are willing to pay for goods will come down, that there will start to be some consumer pushback at a time when we just heard FedEx, yes, you're seeing volumes down, but they're still increasing prices more than expected, and that is a theme across a lot of different industries.
Yeah. So I may go off on a little bit of a tangent. If I do, just pull me back in, because I talk about
surveillance.
Don't worry, it'll happen. Carry on.
So I talk about the consumer a lot. And if you think about the U.S. consumer has been buying, and I'll exaggerate a little bit, since he or she was 5 years old, right? It's a very savvy consumer. We've been spending a lot of money. We know when there's utility. And what I'm seeing is the U.S. consumer has been pulling back. They've been pulling back on goods. They're not finding a lot of utility there. If you look at real retail sales, if you look at retail sales in general, it's not as strong as you would have expected. You are seeing, if you go to the Walmarts and the Targets, you are seeing a trade down. The U.S. consumer's behavior has changed, and I think the U.S. consumer is a lot more savvy than we give he or she credit for.
Going forward then, do you think we have seen this rolling recession in certain areas that offset something that's deeper than an economic malaise? Regardless of what the Fed does, they are cracking certain segments of the economy, and others continue to chug along because of different advancements and less interest rate sensitivity.
You really hit on a great point, and this is something we talk about in the office a lot. You can't paint this economy with one brush, and you are seeing kind of it's a very heterogeneous economy and market. You're seeing certain sectors that have already rolled over and are beginning to improve. You're seeing other sectors that are beginning to roll over for the first time in a while. And so one of the things that's causing this to be an economic malaise is there's not, it's not synchronous, right? The economy is very, very, if you look at the housing market, the new issue market, or the new market is very strong, but the old one is 3 and 30. I'm not going to leave my house because I have a 30-year mortgage at 3%. Very different. If you look at some of the construction spending, manufacturing, warehousing, it's through the roof, but other parts of housing and construction are beginning to roll over. So again, I think you hit on a very important point, and it's something that we really have been diving into, and it's hard to kind of disentangle. But this economy is not, it's not really synced up, and you cannot paint it with one brush, which is why the economy has been a lot more durable than a lot of people have expected.
It's been a huge theme of the program. This lack of aggregation right now is tangible. I want to point out one thing. You can do this off the Bloomberg, folks, the Bloomberg terminal in the description screen, DES. JP Morgan is owned by institutional 75%. Mm-hmm. Apple is owned 61%. I know you don't want to talk individual securities here, but, you know, woe is me, big tech to the moon. We're all going to die. Except, can I make the statement big tech is under-owned by institutions?
I would agree with that 100%. And what I would say is we do a lot of positioning work. And in our positioning work, what we've seen for years is the buy-side community is underweight tech, but it's mainly underweight Apple and Microsoft. We were talking about this in the office 5 years ago, kind of a flip title, but we entitled it Return of the Mac. And what we had seen back 5 years ago is a very big underweight, an exceptional underweight in Apple. That's never closed. And what we're seeing is one of the things that's giving us pause, and I think one of the things that's pushing the market is this underweight in Uber caps in Apple and Microsoft and a few of the others. So I would agree with you what you're saying is the institutions are much more underweight.
Abramowicz, John from Italy emails in and he says, get a new SPX quote from Chris Harvey here. 4,200, can you lift it up? Come on, I got to make some news.
So, Tom, here's what I say. So our year-end
target till late, but hey, no one's watching. Go.
So our year-end price target is 4,200. At the end of last year, we also had a soft landing target. That was 4,400. Right? We cannot.
The two targets.
And it's also the x-axis.
Do you have a Hawkwood target? If we get a Hawkwood Fed, can you give me? Come on, can you give me 4,500 this morning?
No, I can't give you 4,500. But this is why we go back to it's about the economy, because I can make certain adjustments, I can change my estimates, but really, do I have a lot of confidence in that? No. But what I have a lot of confidence in is it's really about the economy. The major trend's not going to break until the economy breaks.
Chris Harvey, Wells Fargo. Can't say enough about it. We protect the copyright of all of our guests. Get this really interesting analog study from Wells Fargo here looking back to the late 1990s, I should say. Futures at -2. Dow futures -20 on the SPX percent. Well, we're fractional. We're down 0.5%. We say good morning.
If you're just joining the program, we are taking a look at what we're expecting to hear from Fed Chair Jay Powell. And I just keep thinking about what Chris Harvey said, Tom, about the economic malaise until the Fed goes full hawk. Essentially, that's the idea, is that unless they get much more aggressive, you're going to have this bifurcated push-pull of all the different industries at different speeds that create a resilience that really has defied a lot of expectations.
I think it's really, really important idea. And I'm going to go back. I'm so sorry I can't cite who it was in the blur yesterday, but someone said it may have been Mohamed El-Erian. I can't remember. The basic idea is this is a Fed that recently has been successful. You see that in the stock market, in that they moved up, lots of criticism, including from Dr. El-Erian, but recently they're honing the message while they figure out how to go higher. I'm not saying I agree with that, but that's sort of a zeitgeist out there that the Fed is. I get you can't. I mean, the wide camera here does show you sometimes the Bremel angst that's out there.
Well, I just don't know that there's any clarity whatsoever from there. I do. I think that there's no real clarity right now with what we're getting from the Fed and the messaging. They don't know what they're doing.
There's a single clarity, and Chris Harvey addresses crystal clear. There's no recession. We got wrong the gloom call.
There's a recession in certain pockets of the economy. This is the sort of strange aspect of the market right now, is that if you go to certain sectors, think about all the white-collar workers that have gotten laid off from certain select slices.
You know, the last time we had a domestic like this, we were in Fairway in the vegetable section, arguing about the carrots.
Yeah, you wanted the ones that just looked terrible.
Well, I did. I wanted the cheap carrots, and you're like, they got to have green on them and be grown up the Hudson River Valley.
Absolutely the opposite. That's all I could say.
She's looking at the carrots, they're Schenker Farm carrots. We got to buy them at $4 a pound. Stay with us. A domestic.
It's clear Russia must pay for the destruction that they've inflicted. So we're working with allies to explore lawful routes to use Russian assets. And on Monday, we published new legislation to allow us to keep sanctions in place until Russia pays up.
The Prime Minister of the United Kingdom, Mr. Sunak, a very busy moment for him, no doubt focused on what the Bank of England's doing with his core inflation surging. What did you say, Lisa, earlier? It's like 31 years back?
31 years has been this high, 7.1% at a time when it was supposed to be falling, and that is core inflation, stripping out energy and food.
Interesting to see, to say the least. The Prime Minister, of course, talking there on Ukraine and on the challenges forward. A quick data check. Futures -4, Dow futures -29. Yields up and elevated, up 3 basis points as well. We need to make note of that, 3.75%. We're not on the 4% watch. They're on the 6% watch in the United Kingdom, aren't they?
Well, some people pushing that idea back. At the same time, what can they do to really kill this? Given the fact that Neil Shearing was saying it's almost a certainty that they're heading into recession. It's just whether the central bank can mitigate it on some level.
Sterling 127.14 as well. One of the most painful meetings I've ever gone to with Bloomberg over many, many decades was at Columbia University a zillion years ago, and it was an Afghanistan reconstruction conference. And it was really painful in the midst of a horrific war. We're doing that again. We're doing it in London with the Ukraine Reconstruction or Recovery Conference, I should say, a Ukraine Recovery Conference. Maria Tadeo tomorrow has a key interview on this with a leading authority. We'll mention this at the end of our discussion. But right now, on the hope of Ukraine recovery, Maria, I don't get it. We're at war in Ukraine. Why are we recovering in London?
Well, that is a key question, Tom, and this already started a year ago. Remember, this was an idea that came up from the Swiss, who said it's great to help Ukraine when the war is going on, but we have to figure out the future and the reconstruction efforts. And it is a very fair question, why focus on the future when you still don't have peace? But Tom, the reality is, the reason for it is the numbers. They are enormous. And today we have the World Bank saying that Ukraine will need, and this is, again, a very big number, $300 billion over the next 10 years as a result of that war. And just to put it in context, Tom, that is 3 times the GDP of Ukraine. So this conference is about, well, making sure you have money, funding, and this constant supply of money. And just very briefly, because this is happening as we speak, we have another pledge from the United Kingdom, which say they will pay $3 billion for Ukraine. Another pledge from the United States, an extra $1.3 billion, but also the European Union saying we will provide 50 billion euros over the next 4 years. So that shows you the magnitude of the task at hand, really. It's enormous.
The day of the invasion, late February, I think it was now 2 years ago, I can't remember, David Folkerts-Landau of Deutsche Bank was absolutely brilliant on the fiscal stimulus, the government impulse to come. You more than anyone I know, Maria, own this. Are we seeing a general fiscal stimulus across an austere Europe right now? Forget about the recovery.
Look, and I remember that night very well because it was that night where European leaders were meeting in Brussels and they decided they had to go for big sanctions and then crossed every line. Remember the energy. No one thought that they would sanction Russian energy. They've done it now. In fact, now they talk about maintaining those sanctions. And also a key point, Tom, it's what to do with the Russian frozen assets. We talked about this at the Munich Security Conference. Remember, this is the key point. Who is going to pay for this reconstruction? When it comes to the fiscal space in Europe, the problem that they have is inflation. So on the one hand, yes, headline inflation has gone down, but core inflation is sticky. So they have to appeal to voters. But you also have the ECB and the IMF saying, well, you have to rein in some of that fiscal space. And on top of that, they're now negotiating some of the new rules that should enter in force from next year. So as you know, the fiscal story is always very political in Europe. It's not just about the fiscal space.
Especially at a time when Ukraine will be looking for money, not only to rebuild the nation. First, they have to win and end the conflict. Will we get some sort of update on what progress they're making right now versus Russia, how the nature of the battle has changed as the conflict grinds on?
Yes, and look, when it comes to this counteroffensive, they are very secretive, and we can understand why. We know that when it comes to defending themselves, Ukraine has become very efficient. We know their air defense is now very efficient, but what allies want to see is progress on the battlefield, to see that Ukraine can claim back some of that land. And they know that this is key, because if you want that constant support, you need to show you have the upper hand when it comes to the battlefield. The other key point for Ukraine, and this will be the crucial issue when NATO meets next month, is what is the path for this country when it comes to NATO. We talk about the future of Ukraine and the security guarantees for Ukraine, but what about NATO? And that has not gone away. That is really the centerpiece now of diplomacy happening in London today.
What's the nature of the conversations, Maria, that you're having, talking about once the conflict is done, before it's done, talking about lining up business opportunities, lining up reconstruction to try to fuel growth and potentially rebuilding? How much can people really double down on hypotheticals at a time of so many uncertainties?
Look, incredibly difficult, and a lot of this, remember, is pegged to Ukraine joining the European Union. They have said they want to become a member, and Ursula von der Leyen, who was very smart on this, got on the train to Ukraine and gave them that survey to potentially become a member state of the EU. But we know that takes years for companies. What they want to see is insurance. How can you do business in a country at war? That is also very difficult. And they want clarity on the Russian frozen assets. This is an incredible story. It's never been done to this extent, to confiscate a central bank. Can it be done? That's something they want clarity to do.
Maria, I've got to digress here. My read of the weekend was Gideon Rachman in the Financial Times with a spectacular article on how, an essay, if you will, on how Europe is falling behind. His data on relative GDP dynamics to the United States was just jaw-dropping. Within your purview from Brussels, is Europe still within Eurosclerosis, as Rachman identified?
There is a lot of, I'm not sure if panic is the right word, but there are certainly fears about the implications of the energy crisis and the medium-term damage that it has done to the European industry. When I talk to European officials here, they say, if you don't have an industry, you do not have a country, you do not have a continent. Emmanuel Macron would probably agree to that. And yesterday, Ursula von der Leyen also appealed to that with a new strategy for the European Union, which she says will focus on three things: promoting Made in Europe, protecting Made in Europe, but also finding new trading partners for Made in Europe.
Maria Tadeo, thank you so much for all your work on the continent of Europe. Ms. Tadeo will join us tomorrow, 8:30. This is an exceptionally important interview, maybe less about Ukrainian recovery and more Ukrainian reality. Dennis Schmel at 8:30 hour tomorrow, the Ukraine Prime Minister. Looking forward to that, to say at the least. The thing I did at Colombia and Afghanistan, it was with Jeff Sachs and the giant Ned Phelps, and it was just so difficult to see well-meaning people talking about recovery in the middle of a war. I just think it was really, really difficult.
About 6 months ago, I was in Europe, and I was having conversations with a number of business leaders about the road forward and what they're looking for. And the one unspoken reality that they all are thinking about behind the scenes, could the recovery of Ukraine, the rebuilding of Ukraine, give that extra boost of growth to Europe, kind of like the post-war reality of the U.S.? And that is something where people actually start the fiscal spending. It is an awkward conversation to be having, as you say, amidst an incredibly painful, ongoing and deepening conflict in many ways. And yet here we have an entire conference around it where people are trying to game out exactly how to do that. Fascinating moment.
It's a character of austerity, and I don't mean that in a negative way, but just a cultural statement of what we want to do on the balance sheet. And if you have a shock like a war, somebody's got to pony up the money for reconstruction. You talk about Ukraine recovery, the pipeline that's in the Baltic Sea that's under huge debate. I mean, there's another infrastructure project to say the least. What about a Russian recovery after Putin? Whatever happens to Mr. Putin, how do you help Russia in a post-Putin sense recover, if that's what's going to happen?
I haven't heard anyone discuss it.
No, it hasn't come up. And it involves billions and billions of dollars. We're going to look at the market right now. We see it with sterling 127.20 off this inflation shock today, and the euro 109.19. Dollar stasis is really what we've had over the last number of days. with DXY 102.59. The 2-year yield 4.71%, further curve inversion. Coming up next, Amanda Lynham, BlackRock. This is Bloomberg. Bloomberg Surveillance on radio and television. John Ferro, Lisa Abramowicz, and Tom Keene. Mr. Ferro on assignment. I think through the end of this week. Maybe he's back Friday. We'll have to see.
No,
on that.
he's out until through next week.
He talked
as well.
to you. He didn't talk to me.
Yeah.
It doesn't tell me anything. Futures are -4. Dow futures -24. Big deal. We really haven't talked about this. The VIX 14? No, 13.74. And I get it. We're buttressed up near recent recovery highs off the October low. But Lisa, there's all these oddities going on. I mean, I don't get it. I had to talk to Dean Kernet yesterday, and even when he talked, I was confused.
People talking about the options market being a bit skewed and ways to play it, and people basically not wanting to necessarily add to their exposure or take back, but they're playing it in the options market, creating some strange diversification of views. The really stasis this morning in the dollar.
Summer here, lots of kurtosis. That's the answer. There's lots of kurtosis. With that, we'll save the data check here. Seriously, we're looking at curve inversion, the 2-10 spread, all the radar up on this 97 basis points, ever so much wider. A revisit to 100 basis points would be a big deal. We're looking at movers now, and after Lee Klaskow, I learned a lot about FedEx from Mr. Klaskow.
To me, the big takeaway is that they're able to raise prices on consumers. Their volumes, though, are dropping, and you're seeing that across the board for all of the shipping and logistics companies. That today, they're all suffering the consequences of below expected 2024 profit outlook by FedEx. Those shares lower by 2.7%, retracing a loss that at one point was down about 7% in after hours yesterday after they reported earnings. To me, though, just to highlight this, they benefited from higher revenue per package and cost reduction actions. If this represents the economy, this means that they're able to raise prices and they're cutting jobs. The sort of stagflationary environment that you're seeing in certain sectors of the economy. And Tom, the Keene cam is picking up some skepticism from you.
My skepticism is there's this place I go, they have a Greek salad, and I don't get it with any add-ons. I can't afford it. But anyways, they got the Greek salad, and all I know is in the last 3 years, the Greek salad's gotten smaller.
Shrinkflation.
Fact.
Yeah, shrinkflation, which is something that keeps going. I also want to bring up Tesla. And you see those shares rallying. This comes after already 35% gains on Tesla just in June. That builds on the 24% advance that we saw in May. Today, perhaps the catalyst is Elon Musk meeting with Narendra Modi of India, talking about possibly building some sort of factory there.
Come on, it's at 80 times earnings. Forward PE, trading at a 10 times valuation of Generous Motors.
Barclays came out and they said that the shares have rallied a bit too much and too quickly, and saying that it's essentially becoming a thematic stock due to artificial intelligence and excitement around the charging. Barclays.
Oh.
Grumble, grumble.
Grumble, grumble.
Grumble, grumble. Yeah. Why grumbling?
I don't know what to make of it. You know, I just don't buy the whole all-in-jump-in AI story, but I don't know what to make of it right now.
To me, the bigger story with Tesla.
That's when Ferro gets back.
To me, the bigger story with Tesla was that if they create the charging networks for electric vehicles for GM and Ford and who knows who's next, that's a game changer, because suddenly this isn't an auto manufacturer. This is something else with a steady stream of revenue from even essentially other auto manufacturers. That perhaps is what's turbocharged.
Yeah, Intel quickly here to sell a division. It's a $4 billion transaction. I guess this goes out to Bain and really talks about I mean, it's IMS, but it's really, I love this, it's nanotechnology. IMS and Nanofabrica. The last AI was nano. We're going nano.
The nano versus the macro. And this has been the real tension of the day as we talk about some of these developments that have bolstered areas of the stock market and the economy, even as you do see a Neil Shearing downturn in other sectors. Amanda Lynham of BlackRock calling the Fed's pause a hawkish skip. A lot of people have been talking about that for the need to curtail inflation, saying last week's FOMC meeting solidified our expectations for a higher for longer interest rate environment. But for corporate credit investors, the pace of additional rate hikes is less less important than the length of time this higher cost of capital environment persists. It's an important point, especially as Chris Harvey says, unless the Fed goes full hawk, we're not going to see anything other than an economic malaise. Does full hawk mean an x-axis that goes for a very long time? Amanda Mlynum, head of macro credit research at BlackRock, joining us now. Amanda, how much more restrictive do 5% rates get as time goes on?
Oh, thank you, Lisa and Tom, for having me. Good morning. Look, I think it's a challenging environment for a large subset of the corporate credit universe, specifically the subset that has a large exposure to floating rate debt. And right now, we've already seen, as you well know, the all-in cost of debt for the leveraged loan universe more than double, actually, since the first quarter of 2022. And the signaling that we've received from central banks, both the Fed and the ECB, is that there's probably more room to run there. And President Lagarde was very clear on that in her press conference recently. So I think that there's more upward pressure. But as you noted at the start, I think whether we get an extra 25 or 50 basis points from here is probably less relevant than the amount of time that we stay in this kind of higher cost of capital environment, because corporates are looking at these upcoming maturity walls, which, yes, they are in mostly 2025, but that will need to be addressed sooner rather than later. And for those corporates, we're not really expecting any sort of relief, certainly not in the form of rate cuts. And I think actually, if you look at where the all-in yields are in a lot of the subsets of the corporate credit market, the risk-free rate has done a lot of that heavy lifting, and spreads are fairly contained. And so there's probably some room for spreads even to move higher.
There's a lot of mathematics there. You get that from Amanda Mlynum. Amanda, let me cut to the chase. Finally, we have a risk-free rate. William Sharp is happy. We got a risk-free rate, and then you got spreads up, and Lisa's pointed out how narrow spreads are. What are the ramifications if the actual yield in an aggregate corporate space widens out? What actually happens to our listeners and viewers?
I think the first order implication is that you see an uptick in financial distress. And you're already seeing that in the default rates. For example, in the US market, the leveraged loan default rate is outpacing the high yield bond default rate by the largest magnitude since the data on the Moody's series that we use began in 1996. And realistically, over the past 2 decades, there have been very few instances where the loan default rate is outpacing the high yield bond default rate. And I think really that speaks to the point that you're raising. It's that real-time marking to market of the higher cost of capital in the loan market as the policy rate has moved higher, borrowing costs for floating rate debt, if they're unhedged, have moved higher in tandem, and that's causing stress for a subset of smaller issuers that don't have the pricing power, they don't have the financial flexibility, perhaps they don't have the refinancing options, and so they're at a disadvantage. Now, that's not a common subset throughout the vast majority of the market, but for the smaller issuers, that will be stressed.
Is commercial real estate either actual or securitized? Is commercial real estate an opportunity or just a massive wait for the washout?
The way that we're viewing it is another reason for banks to be more selective in lending. So as you know, it's a more than $5.5 trillion market. Banks, both small and large, own roughly half of that. And I think it will take some time for the price discovery process to play through. It's reasonable to think that metrics that we used in past cycles, like LTVs, like cap rates, may not be as relevant in this cycle, given the significant change in prices that we've seen, and also given the interest rate volatility. And so I think it will take some time for investors to get clarity on the macro, which determines the cash flows of those assets, and then also to figure out where the real bottom exists in price discovery. That's probably going to take longer to play out than, for example, the stresses that we might see in the corporate credit market among those smaller issuers. But it's something that we're definitely watching because it's so interest rate sensitive. I think the real point, though, Tom, is that just like commercial real estate can't be painted with a broad brush, all CRE is not created equal. Office, we think, is perhaps the most vulnerable. Similarly, in the corporate credit market, quality means much more than ratings. It's really nuanced. It means pricing power, refinancing options, business model resilience. And those are really things that I think will be increasingly important in the second half of the year, because the fact of the matter is that we didn't make as much progress on taming inflation as we liked. There's probably upside risk to policy rates, a higher cost of capital environment. And so we need to tread carefully when we think about what companies and sectors and asset classes are best positioned for that environment.
And the upside risk to policy rates is what people are focused on when they listen to Fed Chair Jay Powell as he takes the seat on Capitol Hill in about 2.5 hours. From your vantage point, you say it's more important how long rates remain high. When does it start to bite the most? One of the maturity walls the most painful, and you start to see the interest rate sensitivity really come to the fore?
Yeah, so we've seen some early signs of that in the default rate, but I would say at current levels, the default rate is still pretty well contained relative to the history. There's probably some upside risk to that. I think when the 2025 maturity walls really become an issue is 12 months prior to those bond maturities, because for a host of reasons, we know that high yield corporates in particular don't like to let their maturities become current on their balance sheet, because that has implications for the year-end audit and going concern language. And so even though 2025 seems far off in the distance, it's actually not that far off if you think that corporates will start to address that in 2024. One really interesting point, and I don't think that this favorable technical will persist, the magnitude of high yield supply and the purpose of high yield supply has been incredibly bondholder friendly so far year to date. It's kind of the best of both worlds. We haven't had a lot of high yield supply, and the supply that we've had has been used for bondholder friendly needs like refinancing and debt repayment. As we get closer to those maturity walls, that volume of supply likely picks up. And so that favorable technical that's probably been an anchor for high yield spreads, frankly, year to date, will probably ease up a bit. And so that's something certainly to watch as we get closer to those maturity walls. But yes, Lisa, to your point, I mean, the length of time and the willingness, as you alluded to earlier in the program, for the Fed to really stay the course and keep rates in restrictive territory or even move them higher is really the key consideration for corporate credit quality.
Amanda, thank you. Amanda Lynham with us with BlackRock this morning. Lisa, what'd you learn there? That's your world. My head's spinning over all these dynamics. You've said the spread's narrow, price up, yield down for corporate paper, and she's suggesting that may reverse.
You put together the ideas of this economy being less interest rate sensitive than a lot of people had expected. That's what Chris Harvey was saying of Wells Fargo. And then you say, okay, well, if you hold rates this high for a year, 2 years, all of those companies that have hunkered down and not borrowed money, all of a sudden borrowing money at those higher coupons that they have to pay, that changes the dynamic. And that, I think, is really important, that it's not just how high those rates go, it's also just for how long and how much that really does pressure some of these companies.
The longer it's there, and of course we've seen that with the Fed, to say the least. The S&P, a fractional -0.1%.
If you're just joining this program, I do have to say that the Masayoshi Son, the CEO of SoftBank, kind of making a sort of about.
We will step lightly here.
Yes. Well, I mean, basically all in on their novelty fund, investing in all of the tech darlings, got absolutely decimated, and now changed tone.
I'm gonna put it in someone else's words. I'll give it to Robert Smith over at the Financial Times, and he said there was a whole tongue-in-cheek thing here. The headline from the FT, and this is on, of course, SoftBank and the disaster that was. I think with Bloomberg reporting, I can say it's been a disaster. Masayoshi Son says SoftBank ready to go on, quote, counteroffensive. The billionaire chief, after talking to Bramo, talks up AI and reveals, when he questioned his achievements as an entrepreneur. Okay. Wow, is this like history reduxing?
So this is a quote from this Financial Times story. Masayoshi Son saying, "We have done enough being on the defensive. I feel the timing for us to go on the counteroffensive is soon. I'm very excited." Here's the issue. Is this an AI-driven jump on the boat kind of enthusiasm? Is this an opportunity that he sees to invest in some of the startups that might not be getting financing through other avenues due to a more restrictive financial policy, monetary policy? We've seen this before.
And again, it goes back to the AI thing. And, we're trying like crazy not to put our our input into it, but I think it's something we can't avoid. In July, we're going to have to talk about artificial intelligence more.
I got a ChatGPT message from my brother yesterday.
Oh, did you?
Yeah, he wrote,
I've never
wrote a
had
poem
one of
to me.
those.
Yeah, it was touching.
It was touching. ChatGPT. This is important. Coming up, Jimmy Ramady will join us, the former CEO of IBM. She has a wonderful book out.
The opportunity for productivity improvement across the S&P 500 and broader equity economic landscape here in the U.S., we think is going to get really interesting here. So longer term, we're pretty comfortable the market can hold a higher valuation, courtesy of mega cap growth and tech, but also because the rest of the market is going to prove out that it's less cyclical than historically perceived.
Scott Cronert, Citigroup, thanks to Zero Hedge for writing up that conversation yesterday with important comments from Mr. Cronert on the market forward. A lot of value there. And Lisa, I thought Chris Harvey earlier with Wells Fargo was something about just forget about the 1990s analog.
That until the economy cracks,
It's not
you
the
can
same.
see the same kind of melt up, and that's certainly what we've seen so far.
We're going to get right to it this morning as we do. Futures flat, the VIX 13.72. I'm not quite sure how to introduce this, but I'll make a go of it. There is a movie. It is called Northside 777. It is of a Chicago long ago. Jimmy Stewart takes a lens and is fabulous in that movie until halfway through you realize there's an old lady on her knees at the Wrigley Building taking the movie, stealing the movie from Jimmy Stewart. And of course, that is the iconic grandmother and mother within called Northside 77. This is an extraordinary book. I really don't know what to say. Ginny Ramady, as you know, it's the most mispronounced name in corporate world. Ginny Ramady with us this morning on a hugely courageous book. And I want to start with the blistering first 50 pages of your childhood. And Baba came to the rescue. Who was Baba?
My great-grandmother. And you're right. And you speak of the Wrigley Building because I was raised by really strong women who all suffered great tragedies. And that was my great-grandmother, who came here from Belarus, the last person alive from her family, who worked third shift in the Wrigley Building cleaning bathrooms, never spoke a stitch of English, and saved every dime in U.S. savings bonds. And one day it would allow us to have a car.
What was the first day like at Northwestern? There were fancy people from New Trier, debutantes from New Trier.
Yes, you know that area.
You going
and there
home?
I was. Yes,
Yeah.
there I was. No, I was there by the grace of God, right? Just lucky enough to get a scholarship. And what I remember is having gone to the store and bought one pair of jeans and topsiders to try to fit in.
Did you use a slide rule?
I did use a slide
Yeah,
rule.
that's
You're
so
dating me
This
now.
is like a nerd fest.
Yes.
Let's
yes.
go to the woman from Chicago who wouldn't know a slide rule if it hit her over the head.
From a slide rule to today, it's actually an appropriate kind of pathway at a time when tech is at the epicenter of how to get from the slide rule to the graphing calculator and beyond, right? How much can you see some of the lessons that you learned at the helm of IBM of how to bring a company up to speed with technology that moves more quickly than anyone could imagine?
Yeah, it's timely because even though the book took me 2 years to write, Good Power, there's a whole section in it on AI. Because a decade ago, I spent quite a bit of time trying to bring AI into the world to solve really tough problems, and here we are now. And to me, the things I learned, everybody wants to talk about the technology. This is going to be a people and a trust problem. That is what I learned from all these years. In that, with something like AI, I see it as two sides of one coin. And if we don't manage the good and the bad at the same time, we're going to have trouble.
When you look back on your legacy at IBM, and you think about some of the advancements that perhaps were shrugged off at the outset, whether it was cloud computing or some of the others, what would you do differently? Or how do you understand what to identify as something that holds promise versus the next, false hope that everyone's going to cling to?
Yeah. Look, I think, this is difficult. It's difficult because actually many of the bets we placed were correct. Some timing was not exactly right on those. But today, everything we did around AI and now it's hybrid cloud is what the company is really growing from. So the idea when you run a company, and IBM's the oldest tech company, and clearly I had to lead it through its most tumultuous reinvention, is that you've just got to make those decisions for the long term, even if you may not see them play out during your tenure.
If you're joining us on radio and television, Good Power, I can't say enough about it. It's summer read thin. This is great, but very dense. 230 pages here on a life story that's extraordinary, and also the realities of IBM. I'm going to address it. You've had critics like a piñata here on the transformation of I've Been Moved. I want to get to Gerstner in a minute, but the way you used to read the statement from Sam Palmisano is you looked at the free cash flow on page 2 of the annual report and you said IBM to the moon. What happened? How did Palmisano get this so wrong?
Look, I mean, what we had done very well to a certain point, but then the world changed.
The world changed.
There was not just one tech trend. There was cloud, there was data, there was AI, mobility, social media. And that's 5 trends, not one.
In the meetings, did you blame McKinsey? Did you bring in consultants who screwed this up? Why did you have such an inertial force where you couldn't change faster?
Yeah, I think what you always have when you're an incumbent in something, it is both you're trying to protect, not just protect a past, you've got customers that you've got to serve, yet you've got to move to the future at the same time. And so that really, I said, every one of us had a challenge, and mine was to now prepare a whole new technology portfolio for the future. But I had a double sort of challenge in that I also had to reskill the workforce. And so when I began, folks weren't prepared for future skills.
At the late in the book, you're phenomenal on this. You go to Brian Moynihan at Bank of America, who's an animal. I mean, I love, Brian, you go, what's the Fed going to do? Baloney. He's a bank animal. He knows the deposit flows in Kansas City. And he talks about hiring for skill.
Yeah.
Does that mean you only hire engineers?
Yeah, look, this is something that I work passionately on now, this idea to hire for people for their skills, not just their degrees. I came to it having had a mother. I was abandoned as a kid, and my mother had no education. But I quickly saw access and aptitude were not equal, meaning she had aptitude, no access to education. So she got a little bit of education and can get an hourly job, a little more, a little better job to get us off of things like food stamps. Fast forward, I would be searching for people like cyber. They're not in the marketplace in 2012. We'd start to work with community colleges and high schools, and I'd say, why aren't we hiring these people? They can do the job. Well, 100% of our requirements are college degrees. And it would lead me down this path for really now almost 2 decades of a movement. I think it's essential to democracy in this country that we revisit, having found 50% of our jobs were over-credentialed, requiring a degree to start when you didn't need one to start. This idea that where you start shouldn't determine where you end. That's skills first.
You joined the show at a really important point, and you're an important voice at a time where we talk so much about tech and how much that's a divergent story from the rest of the economy. Do you think that the big tech names that have really become the behemoths are doing a good job managing the technological trends, managing to train people in the appropriate ways, and creating a path for a longer type of trajectory?
Let me answer that 2 ways. One is there's a whole chapter what I call stewarding good tech, and it isn't just the tech companies. It's now all of us, and as much effort's got to be put on preparing people to see a better future because of this technology. I mean, my biggest learning with trying to roll out AI, particularly with professional people, they don't trust it. Unless they're part of its co-creation and how it's used, won't use it. So as you go forward now, this is about reskilling not just your current workers. It's going to be multiple times in our lifetime. Once and done education is over now. And so that idea that I think that side of the coin about preparing the workforce is totally not paid attention to right now. And to me, that is the biggest thing. And second is really getting people to trust the technology. I had a lot of experience with a big company with a big brand. And when you introduce AI, there's very little tolerance for it to be wrong when you're a big company. A startup, no problem. But when you start using it for health, financial services, you're in a whole different ballgame with how people react to it. So that issue of trust and preparing people are what I think is not being acted on enough.
I'm out of time, but I got to squeeze this in. I got 14 more questions. I got time for one question. What was the best practice of Lou Gerstner?
I have immense respect for Lou, and to this day is a very good friend of mine. I think he was a brilliant both strategist and execution leader, both sides of the coin.
He got his hands dirty, as you say.
Absolutely, and to this day.
This is like gospel to me.
Yes, absolutely. You and
I
share
do
that.
nothing on the show. Everybody puts it together for me. I just show up.
We share that admiration. He is able to simplify the complex in an amazing way.
This is a great book, Good Power, Leading Positive Change in Our Lives, Work, and World. The first 50 pages is blistering. There's no other way to put it. Jimmy, I'm not going to pronounce your last name.
That's all right.
Rometty.
Rometty.
There you go. Nailed it. You pronounce it 4 different ways and hope one of them is correct.
Jenny Rometty joins us. Good Power here this morning. Futures -3, Dow futures -19. Lisa, this book, I mean, you look at how she got to Northwestern is just part of it. It was
the
a
American
little
dream. This is the classic American dream.
Then there was a nightmare of IBM. We won't talk about that. We'll save that for the next interview as well. Futures -3, Dow futures -19, the VIX 13.71. Stay with us on radio and television. This is Bloomberg Surveillance.
This is the sweet spot of people capitulating, beginning to chase this rally higher.
We're going through a regime shift in asset allocation.
The market has a lot of confidence that the Fed's going to be able to see inflation back down to 2% in a year.
These high rates are going to start to impact.
Central banks started out well behind the curve. They're catching up, but they have a lot of work still to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Countdown to Chair Powell. Good morning. Welcome back. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Ferro, and Lisa Abramowicz. Jonathan Ferro is on vacation today, and he will be on vacation, a well-deserved one for the next couple of weeks. It is something that everyone should enjoy occasionally. We are waiting for Chair Powell to take the helm over in front of the House in Washington, D.C. at a time when a lot of people are saying, Tom, that we're probably going to need something more for them to curtail the enthusiasm we're seeing in the U.S. economy.
It's not what it used to be. Mike McKee out with a Humphrey Hawkins tweet today, and it used to be that they didn't talk, and the only thing that matters is what the chairman, his name was Greenspan, said. And so Humphrey Hawkins, there was a huge anticipation, and now, which you've been great about, we've got the speech-a-thon by presidents, governors, vice chairs, and the chairman even, once in a while, less so. But I just don't think it's the same given the over-communication that we have today.
Well, the over-communication, what's been the takeaway from it? We don't know. We're looking too. I mean, honestly, what kind of communication is this?
People know where I stand on this.
But this, to me, the lack of certainty around the data has really been highlighted. Andrew Hollenhorst of Citigroup just publishing, talking about the surprise surge in housing starts, the biggest going back to 2016. Home builder sentiment rising to the highest going back a year. How much does that change the narrative when Fed Chair Jay Powell last week was talking about how the housing market was getting decimated by the high rates? I'm exaggerating, but that's essentially his message.
3-month T-bill, 5.27%, the 2-year 4.71%. With the curve inversion, we see 97 basis points. I mean, the tension is still there. I guess we're waiting for economic data after we wait for Humphrey Hawkins this morning.
Yeah, we're going to get some economic data, the likes of KB Homes. They're going to be reporting earnings after the bell. I think at this point, how much are we hearing, Tom, from a number of strategists? Earnings are going to make it or break it, particularly with big tech.
Yeah, I think that's true all the time. Earnings are part of it, but the question is, do you see a multiple expansion? We're going to address this in a moment with Alicia Levine, but the basic idea of a multiple expansion is maybe the key dispersion right now.
Well, so let's say Apple, let's say NVIDIA comes out and they don't blow it out of the water. No, seriously, just to bring in a little bit of gloom, right? But this is Tesla. The real question. If you don't see the profitability from some of the AI-driven names, do you end up with the biggest market-moving event that puts the Fed to bed? I mean, how much is that what we're looking at?
I mean, NVIDIA is cheap, 57 times earnings as compared to, that's the view next year, versus something like 80 for Tesla. So it's a value stock compared to Tesla.
I mean, I was trying to bring a little gloom because yesterday...
I'm just getting Alicia going. Yeah. She's dozing off over here.
Right. So let's get to her. I will say yesterday we did see a decline, a whole 0.2% decline on the NASDAQ and the S&P lower by about 0.5%. You're seeing a little bit of a softer tone today as well. Again, nothing to write home about, but the direction is interesting based on the melt up and how much that really shifts it, Tom.
Yeah, it is. It's a pause here. There's no question about it. We've seen a pause pullback 2 days in a row. I think a little more excitement today. I should note sterling off of horrific inflation in the United Kingdom, 1.27. Maybe that's why Ferro's not coming home. He's paid in sterling and he's looking large.
The 10-year yield up marginally. The 2-year yield higher by about 100 basis points since early March to 4.7%. And crude just a touch softer as we look out to the potential for slowing growth. Joining us is someone who is always an amazing voice, clear voice, to look through the noise and understand how to parse out what the next trajectory is. Alicia Levine, who is head of investment strategy and equity advisory solutions at BNY Mellon Wealth Management. Alicia, are you expecting anything from Fed Chair Powell today?
So I don't think there's a lot he could say right now that would change the market. It was clear last week that we're moving higher at the peak Fed funds rate. The Fed has been trying to talk this market down. And in the end, the equity market has simply ignored it. To your point, the 2-year has moved 100 basis points in about 2.5, 3 months. And through that, the market powered higher. And so essentially the equity market says, we don't believe the Fed. They're not going to get there. They can't cause the pain. And they just don't believe it. And so I think that's what you're seeing, actually. See, on the one hand, you've got the bond market screaming recession. On the other hand, the equity market saying the Fed's not going to be able to do what they want to do.
I mean, you stayed obviously within it. This dispersion over earnings is extraordinary. I mean, the opinion is like the dots for 2025. Make it up as you go. But that doesn't talk about the dynamic on the P side, which is the multiple expansion. Walk us through where we are now in multiple expansion and what that dynamic will be over the next 12 months.
So we're at a 19 times forward 12 months. That sounds high, but I will say that when you're coming off of trough earnings, the multiple can go higher, much higher, because the multiple expands, as you see, before the earnings do. So for a while, it can look like stocks are very, very expensive. And then what happens is that the earnings catch up. So the earnings dispersion is enormous, because if we do have this long projected recession this year, earnings can be as low as 195 for the year. But if we get that soft landing, you really could be in that 230 to 235, which is where estimates were a year ago for 2023, right? So we priced in a slowdown. If there's no recession, you get to 230 to 235, and then you grow from there. So can you see the S&P at 5,000, 5,200 in 12 or 18 months' time? Of course you can. And so that's really the story here. The multiple's not crazy if we don't get the recession.
Do you have an SPX number? Do you put at BNY Mellon? Do you put a number on it? Or they just really don't want to
We do a range. Our high
range?
We do a range. So the range for this year is 4,500. Our range for next year is 4,800, but we're likely to go.
See that there.
We're likely to go higher. We're likely to go higher.
4,800. Can we come on? It's a show. Nobody's watching. 5,000. I can't get anybody this week to say 5,000.
So the point being, though, where's the recession? And if there's no recession, all of a sudden your probabilities change, your earnings change, your multiples go higher, and then you get that really high multiple that doesn't make sense in a steady state, but does when you're growing off the trough.
When you say if we don't get a recession, haven't we already gotten a recession in certain sectors?
Yes.
So if we have, how does that factor in to this call?
Okay, so let's talk about Q2 earnings. Expected to be down 6% for the second quarter. If it comes in negative, more or less, we know we had that beginning of first quarter. We ended down 1 or 2%, but still there was an earnings recession, 2 quarters in a row of negative earnings. This would be the third. Okay, so we still have that earnings recession. We have a recession according to GDI, gross domestic income. Okay, so that we're in a recession there. And we've had this rolling recession that folks are talking about, but I think really does describe what's happening. And what was weak first were the sectors that really exploded in the beginning of COVID. So tech and goods, those rolled over first, took earnings with it, and then you're seeing the catch-up. And so you can't really get a GDP recession yet because the services are the economy, and that's what's holding up the economy.
Do we get to 4,800 if the Fed keeps rates at 5% or even goes up to 5.5% for a prolonged period of time?
So you can. You can get to 4,800. The key thing is where's the credit contraction? Okay, so what it looks like is that the housing market, which should be the first trajectory through which higher rates filter into the economy, has not fully cracked. Okay, so the demand is so strong, supply is so low, prices are holding up, and we saw what happened with housing starts yesterday. So there was a slowdown, and in a sense, it's the rate of change. So if your mortgage rates are staying where they are and not ratcheting higher, you're getting people saying, okay, this is where mortgages are, but we need a home, and so we're going to pay it. So the housing market's not cracking. If the housing market's not cracking, then where else are you going to see the credit contraction? The banks have contracted lending, but there hasn't been an inflection in the trajectory since March. It's the steady slowdown that we've seen since last September. So there's no increase in the rate of change of that. Do you see problems in commercial real estate? In some cities, in some areas, it looks to be well-defined right now. That doesn't, I don't want to sound Pollyannish, but right now, you'd have to say credit is contraction. And it's not everywhere. The markets are open for bond issuance.
She's doing her Haley Mills imitation. John from Capri emails in from Los Smeraldo, lunch at Los Smeraldo.
Okay.
Says, we're talking to 5,000 with Alicia Levine. He says, what's the Dow equivalent? The Dow equivalent on SPX 5,000, Lisa, is 38,400. That's where Alicia, I'm making up this as we
No
go.
kidding.
We're
Everybody knows you're making this up
we're
in every
nudging
which
it.
way.
I'm trying to get Alicia to 5,000.
I want to be on vacation in Italy.
Exactly. And John would not be asking about the Dow. Absolute
Beachside.
fallacy. I will say, if nothing is cracking, Alicia, does that mean you go all in? Do you buy this, or do you remain cautious and say, something doesn't feel right?
So that's not how we manage our portfolios. We manage our portfolios based on risk profile. So that's the first thing I have to say. I don't think you go all in here. The move we have had has been extraordinary, and it has been in the face of stickier inflation in services, with the Fed saying we're still going to be there. I don't think you can fully ignore it because there will be some tough moments. I think we're fairly valued here. So I think the summer could be a little bit of a difficult summer, or just a pricing and consolidation. But to the point of what's led the market, you really have to see the broadening out into the deeper cyclicals to keep this going. I mean, as of yet, you need to see the financials. You need to see energy. Look, REITs are on their back. And so, you have to see some broadening of participation. The cyclicals also went through their recession a year ago. PMIs have been below 40, below 50 for a while. This is where you buy these stocks. You don't buy the stocks when PMIs are 56. So it feels like the recipe is there for that, but you always have to look for what the next trade is. We've come really far, really fast. And you have to see the small caps work. You have to see the cyclicals work. You have to see the dividend stocks work.
Alicia, thank you so much. Alicia Levine, I couldn't get her to 5,000. I failed. We'll work on it. I like the banded idea. That they don't do a single point. They do a banded idea. Futures negative 7, Dow futures negative 34, the VIX 13.75. Standard & Poor's 500, it is down 0.2%.
And this comes as we do await Fed Chair Jay Powell, who is poised to take the helm over on Capitol Hill in about an hour and 45 minutes. Whether it matters is another question, Tom, at a time when people are looking at the underlying dynamism. We haven't talked about the thing I've been really focused on the most over the past 24 hours. And I'm kind of embarrassed to say this, but I've been looking at this submersible. I've been tracking it and trying to understand
what a difficult story this morning.
What it must be like to be trapped 13,000 feet under the ocean, waiting for someone to find you. It's a horrific story.
It's a horrific story. To review this, if people haven't followed it, it's been a mystery, and then reports by the Boston Coast Guard through them of a little bit of research on noises from the water. The conventional thing is banging, if you will, on metal, and it's hugely difficult sonar technology that we're guessing against this timeline of oxygen.
Well, the technological kind of discussion over the idea that people are probably banging on the side saying, hey, we're here, and how do you find them in the race with oxygen quickly running out, less than 40 hours, it sounds like here. We will track this, but the global effort to find this vessel and bring it back has been tremendous, and we'll keep watching it and hoping it has a happy ending.
Well, we'll look for a happy ending, but right now it looks to be very difficult. Bloomberg is following this from London and from New York, and certainly from our Boston offices as well. Futures at -8, Dow futures -42. Single point. Let's go to pound sterling, $1.2721. Flat sterling within the absolute shock of core inflation across the United Kingdom. Coming up on Her Washington, Henrietta Trey's of Veda Partners. On radio and television, this is Bloomberg Surveillance.
The relationship and the communication between the two leaders, between President Biden and President Xi, is most important of all. That's why they've had a number of communications and meetings to date, and that's why I expect you'll see more of that in the time ahead.
The Secretary of State of the United States, I will editorialize with a sense of exhaustion there, in his travels here the last number of days has been extraordinary, from China to other points and then to Washington as well. Blinken there on Ukraine. Maria Tadeo tomorrow with an important interview in Bloomberg Surveillance with leadership from Ukraine. Looking forward to that. Part of the joy that we have is we get to read our guest notes. Our team does a great job of collating in all of their thinking. And to read Henrietta Trey's is like poetry. She writes completely different about Washington than what you see in the newspapers. Economic Policy and Research Director at Veda Partners, Henrietta Trey's has a curtness and directness. And what's stunning about your note, Henrietta, is your directness about we're delusional, we're going to cut spending. You go into the Pentagon budget, paragraph 1, paragraph 2, paragraph 3, you're basically saying you're out of your mind if you think there's any austerity on Capitol Hill. How did we get here?
Well, that's really kind of you, Tom. And unfortunately, I'm like that in real life also. So I'll just be really honest about it. I mean, we had a big fight about deficit spending over the debt ceiling negotiations, or debacle, if you will, as we all covered at the time. But at the end of the day, the reality is you do not have the votes or even really the will to reduce this federal spending in any kind of a meaningful way. And as the Federal Reserve is making decisions on whether to hike interest rates, pause, or anything else in the next couple months, we have to be clear-eyed about whether or not the federal government is going to continue to provide increased federal spending or reduce federal spending, as you know, your macroeconomist at your hedge fund or wherever is trying to price in exactly what's going to be coming towards the economy in the next couple of months. And the reality is, as we're going to hear from Blinken, Secretary Blinken later on today, there's going to be additional calls for funding for Ukraine, as we have had since the start of the war. I assume that's going to be at least somewhere in the $30 to $60 billion range. You have Republican members calling for increased aid at the border, $12 billion here, $15 billion there for fentanyl or Title 42 or what have you. Then you have increased calls for all of the flooding or the hailstorms or tornadoes, or hopefully not, but any hurricanes that happen. These emergency supplementals are loopholes you could drive a truck through that are in that deficit debt bill. So that's what's coming our way in September.
Within the granularity which you're expert at, how do you perceive people like the Peterson Institute, or frankly what Peter Orszag did years ago at Brookings, or what Center on Budget, the Center CBO, the Congressional Budget Office? How do you perceive how close we are to a fiscal panic as you people spend?
You can get stuff from like the CFPB that says, hey, we really need to rein in our deficit. And you will hear that from certain members on the Hill. But the reality is there is no likelihood of materially reduced federal spending. You know, we have a debt ceiling of $33 trillion basically by this time next 2025, or the first quarter of 2025 when they have to hike it again. There is an effort maybe to trim $150 billion in federal spending. I mean, that's literally a drop in the bucket, less than a drop in the bucket. So there are no material efforts underway. And CBO effectively prices in the near term, but none of the long-term stuff. And they're pretty blunt about it also. If you read their scores and some of the footnotes, they just do not assume savings where there aren't going to be any. The perfect example would be clawing back the COVID relief aid that went out during the pandemic. In parts of that, they don't even factor in savings because they also just assume that that money wouldn't go out anyway. So they're pretty clear-eyed. I love the Peterson Institute's work. I think it's tremendous and follow it closely. But you really have to, nail senators and congressmen down and get them to hear what they're saying about any of these realities. And that's often overlooked in the rush of the day-to-day.
And it's also overlooked because nobody cares. The focus is squarely on Hunter Biden and the former President Trump's legal troubles, which has sucked all the oxygen out of the room. How much is that going to dominate the election cycle, much more than anything of the nuts and bolts of how the economy works?
Lisa, it's such an incredible question because there is a huge tax bill that is hanging in the limbo coming up on the next election. 2025, all the 2017 individual tax cuts expire. And the R&D and the EBITDA shift and all those components have already dropped off and the individual stuff will expire. So you have this opportunity for a huge conversation about fiscal responsibility, pulling the subcommittee, the super committees that we've talked about before back together. And none of that is taking front and center position because we're talking about Hunter Biden, because we're talking about, 3 or however many indictments there are against President Trump, the Republican infighting with 15 different candidates on the walk. I mean, there's no shortage of other things to talk about, and no one's concentrating on the tax policy stuff, which is a shame because it's a winning argument for voters who care more about the economy than any other issue.
And it's coming at a time where these aren't just window dressing topics. And I think about the case against former President Donald Trump and the court date that was set that was really quick. Unclear whether that will actually be a real court date. How much does that shift the landscape, though, heading into an election cycle where this is the proposed frontrunner for the Republican Party?
Well, this is sort of what I tell to clients. In order to combat President Trump, he really needs to either go to jail, be indicted, or bow out of the race. Because right now, no other candidate has a shot. If he is plus 33 against his second closest competitor, even if DeSantis were to make humongous strides in fundraising, in voter outreach, in turning people's minds around, he's still only halfway there and still down, call it 15%, even if he, cuts his lead in half. So there really is not an opportunity for another candidate. And then, you have the Pence, Haley, Chris Christie lanes, then they poll below 5% every single time. So Trump is the clear and away frontrunner. It is historically consistent. Fighting against that is the fool's errand, I think. I assume that the candidates are Trump and Biden. This is a relitigation of 2020. Right. And as we have seen every election since 2018, when Trump is at the top of the ticket, Democrats win and Republicans lose, sometimes by historic margin.
Henrietta, we had Eric Cantor in London with our Francine Lacroix. Let's migrate over to the House. How's Kevin McCarthy doing? 45 seconds. How's Kevin McCarthy doing?
I think he's fine for now. He will be in for a heck of a time in mid-September. All he's doing is staving off the inevitable. We could very well have a shutdown. The odds are rising. You're going to see these emergency supplements, OCO spending. He's going to have a tough walk ahead. It's going to get uglier. Thanks for the brief. Henrietta Trey's with us, Veda Partners there. I'm not framed that out through August that we get to a shutdown.
Well, some people are talking about that, given the fact that there still is some debate over what has been approved. And then, of course, there is this additional spending. I mean, she's right to point that out, how much the spending is actually going to be increasing despite all of the noise around the debt ceiling.
I mean, in the recent history back to Sam Nunn, Paul Tsongas, Pete Peterson, and the rest on the budget angst. But really, the budget angst back at least half a century on the expansion of our federal America. It's just been this one cry wolf of potential panic and outcome. And it's that way until it's not. You wonder when it breaks, when it snaps.
I'm a little distracted because Mohammed El-Arian just put out a column that caught my attention. The headline being persistent UK inflation should worry everyone, talking about how, yes, this is a UK story, but it points to a sort of trend that is ongoing with a lot of the central banks fighting a situation that is exacerbating inequality, creating a greater risk of stagflation, and creating higher borrowing costs for all. And this is really the concern as it grinds onward for a longer period of time.
This is the disaggregation theory. I mean, the idea that we aggregate our macroeconomics, I'm going to take it back to 1947, maybe, where this was codified in the modern day. I don't buy it. And, you know, John Edwards, Two Americas, maybe it's 3 Britons, maybe it's 4 Britons. But this is a huge societal story about the cost of inflation.
And it's really apropos to talk about this in tandem with the policy discussion. Mohamed El-Erian goes on to say, it reinforces the point that the urgent goal of bringing down inflation in an orderly fashion cannot be met just through interest rate increases. Also has to improve the supply chains, productivity, and a whole host of other policy considerations.
Yeah. Well, productivity is the unspoken there, something we talked about earlier. Jeremy Stretch, I believe, to be with us. He'll have a British look for us as well coming up. Francis Donald as well from Manulife. Francis Donald on the American economy. Stay with us. It's Bloomberg Surveillance. Bloomberg Surveillance, Jonathan Ferro on assignment, Lisa Abramowicz and Tom Keene driving through the week here. It's a more interesting day than it was on Tuesday, no question about that. Futures -12, little deterioration in the tape in the last number of minutes. But at least in the yield space, we continue to elevate yields, and we're not going to make 4% by the end of the show, but nevertheless, yields come up a little bit.
The grind higher has been tremendous over the past 2 months. That, to me, is the takeaway. 100 basis points increase since early May, just on the 2-year yield. We have reset expectations. Markets have powered through. There is a disconnect that either we've seen a sea change from AI and tech or that something else is afoot, that there's going to have to be a reckoning.
We've got news now, and it is on Humphrey Hawkins. Michael McKee out with a wonderful tweet today on the history of all this. Coming out of the war, and little did they see the horrific deflation of 47, 48 coming, was the Employment Act of 1946. And then 2 people, Humphrey of Minnesota and Hawkins, I believe, of California, Hawkins of California, decided to amend it in 77 and 78. I have the clearest memory of this being hugely controversial. But Mike McKee, it was done in a time when the chairman of the Fed really rarely spoke. Today we have massive communication of our central bank. What's the value this morning of the Humphrey Hawkins testimony?
Well, the prepared testimony for Jay Powell is out, and it's a bit of a Groundhog Day. Nothing new in the statement, a cut and paste job from his opening statement at the press conference last Wednesday. If you were going to pick a line out of it, you might say, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. And then he repeats the phrase we used as our key quote last week. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at last week's meeting, considering how far and how fast we have moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. His diagnosis of the economy, the same. The labor market remains tight, and the inflation numbers are well above their long-term 2% goal. They are seeing tightening in interest rate sensitive sectors, but the extent of that is uncertain, and they'll make decisions meeting by meeting. And in making those decisions, they will look at the cumulative tightening of monetary policy, the lagged effects on economic activity and inflation, and economic and financial development. So if you liked what Jay Powell said last Wednesday, you're going to like it again today.
Sounds like over-communication to me. Mike McKee, can he move the markets today?
Well, he could. The question is going to have to be asked in the question and answer period of what do you mean by additional firming? Do you really think you're going to want to go 50 basis points as the new dot plot suggests? And if so, when are you going to do that? You said July was a live meeting. Do you anticipate raising rates in July? And would you go 25 or 50 basis points? Is this going to be an every other meeting kind of move? Those are going to be the questions that could move markets today. today. Powell also likely going to talk about bank reform, new regulations after the March issues, but that's not going to move anybody's needle.
Mike, an improvement would be if you could be the congressman from New York or whatever, and you could ask a question of Powell at the Humphrey Hawkins testimony. That would be a big improvement, I think, this morning. Michael McKee, thank you so much as we look towards this important testimony by the chairman. Frances Donald is with Manulife, global chief economist and strategist. She's very good at writing blistering bullet points that cut to the chase. We're going to cut to the chase, which is we all know the U.S. is way out front on inflation versus what we saw in the United Kingdom today, and even Europe, Japan being the oddity as well. And you look at the nonlinearity here. You pick the 0.3%. The answer is core inflation's coming down. There's a little bit of a vector in place, but you say the path to 2% is going to be brutal.
Well, the path to 3% is probably going to be quite easy. We'll be there in the next couple of months, and then a lot of people will claim victory. Yeah, for sure.
Why?
And
I don't see it.
Well, a huge element of this is base effects that are coming through. That's just a big part of it.
Looking back 12 months ago.
But you do point out something really critical, which is that if we talk in year over year, inflation is healing. But for most Americans and, in fact, global citizens of the world, their price pressures are not coming down. They're still paying substantially more than they did several years ago and are still going to have that embedded view that prices are substantially higher. And that's why these central banks, the Fed, the Bank of Canada, the Reserve Bank of Australia, the BOE, cannot imply that rate cuts are coming. If they do that, we will see a reinflation of inflation expectations.
But they've basically said that. And you're still seeing a group of people say inflation is going to be hotter for longer. They don't have what it takes to actually come through with these expectations. So at this point, if they don't raise rates further, will they lose the battle with inflation?
Well, no, because a big segment of inflation is not coming from interest rate sensitive sectors. Yes, some portion of it is, but we are in a new paradigm in which inflation is being driven. I know we've said it for years now, more by global, more by supply side factors. So as we move forward, and this is why, this year is interesting, the July meeting is interesting, but what keeps me up at night is 2024 and onwards, because we're heading into an environment where 2 to 3% inflation, in our view, will become the norm, and central banks are going to have to make a decision. Do they continue to launch us into recessions or lower growth in order to put us towards 2%? Or do they admit that the nature of inflation is changing and 2 to 3% is more what we're going to be looking at?
This is so important, and there's a lot to unpack within this. If 2 to 3% becomes 3 to 4%, how do they make sure it stays within a certain range and keep their credibility? Are you saying that it would be a mistake for this Federal Reserve to go to 5.5% or even 6% in terms of a Fed funds rate in order to bring inflation down faster, because all they would do would be to torpedo the economic growth without necessarily changing that paradigm?
What I'm saying is that it's a mistake to ask central banks to solve inflation all by themselves. That as the nature of inflation changes, we have to have some hard conversations about what we're asking global central bankers to do. Now, the Fed has a little bit of an out because it has a dual mandate. It can look towards the employment side of the picture, which, by the way, they're going to have to change the metrics they look at in order to do that. There are other central banks that have single mandates that are only targeting inflation. Those central banks are going to have to say, what is the cost of 2% now that the nature of inflation is changing?
If you see the disinflationary trajectory you're outlining, a soon-to-be serious disinflation, what does as a labor component non-farm payrolls do? I mean, we have people that come on that suggest we could see an abrupt decline in non-farm payrolls. Do you buy it?
Here's the issue with the employment data. Now, in the past, we would look at non-farm payrolls as a good indicator. We would look at the unemployment rate, which, of course, is what the Federal Reserve
looks at. So what do you look at
at
if you're not looking at them?
I am looking at weekly hours worked, among other indicators. And the reason for that is we have companies that have been very clear they are still scarred by the labor shortages that have persisted over the past several years. They will attempt to cut costs, likely in ways that are not laying people off. But what we're likely to see is you stay employed, you get to check that box, but the amount of hours that you're asked to work decline. Now, weekly hours is already back to pre-COVID levels, and yet I hear all the time, but the labor market's on fire. Well, not if you look at the actual amount of labor being consumed in this environment. The unemployment rate is still going to be probably rising very slowly. We don't actually have it going above 5%, even in a recession, but the amount of labor consumed is going to be lower.
Right.
This is why our metrics have to broaden.
Lisa mentioned earlier something we've talked about in surveillance for quarters, I would say now, which is the solution is patience and expansion of the x-axis where they stay higher for longer. To me, that's just it's a more efficacious move than to worry about 25, 50 beeps up, down. Do you buy that?
Absolutely. Well, the solution to most things is patience, Tom and Lisa. I agree with you on that one. So when we discuss our forecasts, yes, we have penciled in one more rate hike for July, but what we spend much more time thinking about is the response to the next recession. And at this point, what we're looking at in 2024 is, yes, the central banks do cut, the Federal Reserve does cut, but only towards what they view as neutral, that they don't actually go into easing territory, they stay restrictive. And of course, that brings a question that I know you love to ask on this. What the heck is neutral? That we don't know for sure.
When you talk about the resilience in the face of the rate hikes and the lack of interest rate sensitivity in certain areas, what do you make of the fact that markets have continued to rally, that we've erased all of the losses incurred since the beginning of the rate hikes, and that we've seen two-year yields rise by 100 basis points in the past month and a half?
I think you used the word reckoning earlier, which is, I think, an important moment. We have historically, for my entire career, believed that as you face a recession, central banks respond. And indeed, my job on the buy side working for an asset manager is to input our forecast to see what different asset classes are going to do. In a recession, we start saying, okay, there's going to be an opportunity for equities, for fixed income throughout this. But when we start modeling recessions without material rate cuts or with less rate cuts, then we actually see a very different asset class return. It is not a standard recession playbook. So what I think is happening now is a market that's coming to that realization that recession or bank failures does not equal rate cuts. This is a paradigm change from how we've looked at things.
So why is there such a resilience, right? If that's not going to be rate cuts to the rescue, is that reckoning going to be lower, or is it going to be that maybe this economy just isn't interest rate sensitive in the way many people expected?
There is an element of that, and there's certainly no shortage of soft landing. Now, the issue I have with that and why I think there's a disconnect right now between equities, which are being distorted by the AI story, there's no question about that, and fundamentals, is that every single leading indicator of a recession is flashing red. Deeply red, Lisa, like flashing red. So even if I say to my team, okay, I want you to cut in half those indicators, is it still a recession? The answer is yes. So if you want to make the point that it's a soft landing, you have to discredit the bulk of indicators that have traditionally told us a recession. And you can do that. And there are some strategists that have made very good points about excess savings and labor shortages, but I'm not quite there yet. So a recession ahead means there's a disconnect between prices and fundamentals. That's when we make money, Lisa.
30 seconds, quick. Is the stock market disassociated from your cautious economic view?
Yes, but that's okay. We have tactical time frames, medium time frames. Macro is not everything all of the time.
Canadian thing, medium time frame.
As much as I would like macro to be the driver, sometimes you have to trade off of momentum, technicals, and sentiment. If you're a tactical portfolio manager, that's the moment. And recession may still be a couple months away. So sometimes there's a disconnect. Depending on your time frame, that's also an opportunity.
Francis, thank you so much. Francis Donald with us with Manulife of Montreal. Manulife Investment Management, I should say, as well. Yeah, I look at this, and there's as we know, that's what makes surveillance go. There's 42 different opinions, 42 different flavors out there.
I love what Francis was saying about every indicator flashing red. How many people have said, well, the indicators are broken? How many people are saying this is a different time, and nobody wants to say this time is different, but everybody's saying this time is different. And more people are saying soft landing, no recession, simply because, we are seeing a pandemic distortion that we haven't seen since 1918.
The 2-10 spread out to 97 basis points. On the SPX, Standard & Poor's 500 down 0.2%.
I will just say that I'm going to be filling in for John Ferro in the next hour. And coming up, we've got some incredible guests we're going to be speaking with as we bring you into the open. Brian Weinstein of Morgan Stanley, he can weigh in on this. Anastasia Amoroso, iCapital, and Patrick Frizzetti of Hightower. And we'll be talking about this dissonance that we've been seeing about these forecasts for recession that people are kind of ignoring more and more, even as the Fed kind of is getting uncomfortable by not.
My head's spinning from the opinions today. They're all over the place. I mean, it's extraordinary to me, the difference. Somebody had mentioned the word dispersion. I think it's Alicia Levine of BNY Mellon mentioned the earnings dispersion. There's a theory dispersion going on right now. I mean, I literally could write it. I do like a LinkedIn essay on that. There's a theory dispersion out there.
When it comes to how long rates have to be high, when it comes to whether we are going into a higher rate environment, as Francis was talking about, for the longer term, or whether we're talking about something going back to what we used to know with respect to low rates and low inflation. And that's the dispersion. We have completely disparate views on that.
I mean, I'm looking at 2-10 spread plunging here in the last number of minutes, no doubt off the Powell testimony and the non-event of it, as Michael McKee covered. We'll have that for you on Bloomberg here later this morning. But we're at 97 basis points. The difference in yield between the 2-year and the 10-year is almost 1 full percentage point, the 2-year higher. And you know, it's moving with some real strength, is another way to put it.
It's really within spitting distance of the lowest going back to 1981, the last time the Fed was on this type of hiking cycle.
Some of the historic scale, of course, we saw that in the United Kingdom this morning. Thanks to Neil Shearing of Capital Economics. It was just wonderful on UK analysis. Futures at -11, the VIX stunning, 13.80. This is Bloomberg Surveillance.
I think we can all agree that the economy is a lot less interest rate sensitive than we thought. The way we're characterizing the economy is an economic malaise. We thought the probability of recession spiked with the banking crisis, but now we think that's come back down. And so we're really looking at an economic malaise more or less than a recession on the horizon.
Chris Harvey of Wells Fargo, really interesting there with a bullish construction on the market and a terrific analog study back to the late 1990s into 2000, 2001 on the tech boom that we're all living. I really urge you to find that report from Wells Fargo. Chris Harvey from Wells Fargo this morning. I wanted to take a pause here, and I understand it's mid-morning in the United States of America, but what's going on in the United Kingdom is absolutely extraordinary. Lisa Abramowicz just mentioned the writings of Mohammed El-Arian just out moments ago. It's something we'll digest through the day. We'll look at all the different economists. Neil Shearing, thank you for joining us earlier. But I thought we needed someone grizzled and ancient who really understands the value and dynamic of foreign exchange and sterling dynamics as they tell the story of the United Kingdom. It is a fear about core inflation. It's a fear that clearly we'll hear from Capitol Hill types talking to Chairman Powell this morning. And we get a brief now from London. Jeremy Stretch joins us, head of G10 FX strategy at the Canadian CIBC. Jeremy, thank you on short notice for joining us. I just thought your note was absolutely brilliant. The regression on cable, on sterling US dollar, is just simply weaker sterling since 2016 and Brexit. Is that slight, modest, measured depreciation still in place? Is there still a structurally weak sterling?
Well, thanks for the introduction, Tom, with the grizzled veteran element. But I think in the context of sterling, I think we have to remember that this week will mark the 7th anniversary of the UK population deciding that it wanted to exit the European Union. As a consequence of that vote, then we did revise down, or we would assume that there is a lower threshold for an equilibrium value of sterling than would have otherwise have been the case. So we are in this sort of lower for longer trajectory because macroeconomic activity will be less robust. And ultimately, as we're just demonstrating in terms of the recent inflation print, the structural inflation dynamics are somewhat higher. And clearly, when you have an inflation differential, which unfortunately is in favor of the UK relative to elsewhere, that invariably implies and results in a currency which needs to depreciate and underperform. So we have seen a sterling recovery from obviously those lows that we saw back in the autumn of last year during the Truss fiscal debacle, when there was that immediate fear of parity. But I think we're now in a situation where we're back into a sort of a 120, 140 range as a sort of longer-term fair value range. And ultimately, if we do get to the midpoint of that, I think it's tough to see any obvious reasons or suggestions to move substantially higher.
If I was in London with Francine Lacroix, we'd be looking at euro sterling, folks. But because of it's 8:49 Wall Street time, I'm going to really stay on cable here, which is sterling dollar. And, you know, I look at this Jeremy Stretch, and the obvious idea is how much can sterling reach out, even given the challenges of the greater United Kingdom? Dare I say we get back to a 140 like 2018 or early summer 2021?
No, I think that is by far a step too far. So if we have that sort of 120, 140 range as the sort of the basic broader principles for the sort of sterling trading range, I think it's tough to see how we were going to get to the upper extremities of that range over the course of the foreseeable future, because clearly, as UK terminal rates have been pushed higher over the course of the last month or so in particular, as the inflation pressures have become amplified, then if we do see terminal rates being priced at roughly a 6% threshold, which we have done periodically, then that just amplifies the recession risks vis-a-vis the UK into 2024. So whilst we can talk about the hard landing or otherwise in terms of the US, I think the UK is infinitely weaker in terms of its fundamental story relative to where the US is. So it's rather difficult to see how we can see a material appreciation of sterling beyond the sort of maybe 130, 132 extremes over the course of the next 12 to 18 months. So I think that 140 threshold, I think, is very much off the agenda for the foreseeable future, unless you take a materially weaker dollar narrative than we would be prepared to accept as far as CRBC is concerned.
Jeremy, I want to get to a dollar discussion, but I really got to look at renminbi on an absolute devaluation tear here. Renminbi from 6.70 yuan breaching out this morning, folks, to 7.18. The high was 7.19 yuan. This is on a tear. Jeremy, from where CIBC sits, with all of its Asian heritage, is this an orchestrated depreciation, or dare I say devaluation by Beijing, or is this a free and floating currency?
Well, of course, it's not technically a fully freely floating currency, but I think investors are looking at the macro dynamics in China and particularly reorientating their expectations of the reopening narrative and coming back to the conclusion that clearly the macro dynamics that we'd hoped for as China reopened are not as constructive and robust as we had hoped for or anticipated. And so we are seeing the currency depreciate and reflecting that weaker economic performance. Also, I think investors were obviously a little bit nervous or a little bit disappointed in the context of that reduction in the 5-year rate earlier in the week, because there had been some hopes that there would be a greater reduction to try and stimulate the real estate sector a little more aggressively. So I think it's more a case of disappointment regarding the reopening narrative. I don't think it's necessarily a managed depreciation or anything of that magnitude. And I think if we do see anything north of 720 in the nearer term, I think that does feel as though that downtrend in the CNH is relatively fully valued. And ultimately, I would still expect by the end of the year that we're probably going to be trading back towards the 7 threshold and perhaps a little bit back below it.
On radio and television, Jeremy Stretch, CIBC, with us this morning. Let me get back to the center tendency, which, of course, our American audience is most focused on, which is dollar durability as well. Jeremy, I've been worn out by people calling for weak dollar. It just really doesn't happen. Give us an update on the CIBC view on the full faith and credit dollar.
Well, I think in the nearer term, I think there is still some value to be had in the dollar. I think in the context of the Fed, I think the market is still perhaps underpricing the possibility of the Fed pushing through not just one July hike, but I think possibly September 1 as well. So I think that's underpriced for the market. So I think they can and should see the dollar gain some traction off the back of that. And I was just listening with interest to some of the conversation you had with Francis Donald earlier from Manulife, and we would agree that I think the Fed will certainly hold rates at a restricted level for somewhat longer. So I think that's also supportive for the dollar valuation. However, having said that, I think there is still that globalized demand for that diversification away from dollars over time. So I think in the next 2 to 3 months, we can still see the dollar making gains and still being pretty robustly supported. But I think over the medium run, so sort of 6 months and beyond, then I think we can see just a graduated but modest degree of reduction in dollar valuations.
John emails in from Capri. John, thank you so much for listening to us on Bloomberg Radio this morning, or this afternoon, I should say, over lunch in Capri. John in Capri wants to know, Jeremy, what's the tradable pair right now? Where is the opportunity among all the pairs you look at?
Well, I think in the context of all the pairs, I think you need to look at those that are probably becoming most dislocated from market rate expectations. So I think certainly, as I say, I think there is valuation in terms of the dollar story as we reprice the Fed over the course of the next 2 to 3 months. I think in the yen, I think there can and should be some opportunities in the yen as well, because markets are giving back their expectation of any policy change from the BOJ, but I think we shouldn't downgrade that. And I think in terms of some of the Scandinavian currencies, we've seen those pretty beaten up over the course of the ensuing months. And I think there's certainly some potential there for a snapback if we start to see that sort of downside risk in terms of the global story starting to find a little bit of a base. And I think that would be much more constructive for some of those Scandinavian currencies as well.
Terrific brief. Jeremy Stretch, thank you so much, particularly there on the United Kingdom. He is with CIBC in London. I really can't say enough, folks, about the shock that we saw this morning on core CPI in the United Kingdom. I don't care how far removed you are, like I'm removed from it. The duration back, as I believe Lisa mentioned, 31 years back, to see that kind of persistent core inflation, and as Dr. Alarian mentions, the societal effect of that is really something. Jerome Powell to speak this morning, that will be important. Michael McKee with his treatment of those embargoed headlines. This afternoon, this off of Bloomberg Technology in the 3:30 hour. Look for the president, the chief executive officer, Antonio Neri of Hewlett-Packard Enterprises. This is Bloomberg. Good morning.